quite welcome. So in this particular session, we have decided to pick up property, plant and equipment. Of course, it is quite a formidable standard. When we are studying the guidelines of property, plant and equipment, it means simultaneously we are doing AS-10 and Ind AS-16 because AS-10 and Ind AS-116 are absolutely same. Correct? I hope you got the vertical point which I'm trying to actually put in your mind. That means when we are studying property, plant and equipment, it means either we are studying accounting standard AS-10 or we are studying Ind AS-16. So here we go and take up the issues of this particular what we call standard. So let's begin what we call this. As I said, property, plant and equipment, this is a standard which we are actually doing. In fact, when we say that we are doing property, plant and equipment, it also means that simultaneously we are killing two birds with one stone, as the saying goes in English. Correct? So let me write here AS-10 or AS-10 or Ind AS-16. Ind AS-16. Absolutely same. Correct? So, as far as guidelines of AS-10 or Ind AS-16 are concerned, that is absolutely same. So, let me start. Point number 1. Aforementioned standard, that means AS-10 or Ind AS-16, aforementioned standard, aforementioned standards deal with, as we normally write, deal with what? Deal with, as I said, let me pick up the red pen, property, plant and equipment. Property, plant and equipment. And every time we cannot write property, plant and equipment, so we shall use the acronym PPE. Correct? To denote property, plant and equipment, we will use PPE, the acronym, and in fact, this short form is generally used. So, aforementioned standard deal with the property, plant and equipment. Correct? And what are the principal issues which we are going to, of course, confront in this particular standard? The principal issues, or as far as of this particular standard is concerned, because name itself is suggesting that this particular standard happens to deal up with property, plant and equipment. Quite obviously, it means we are dealing up with the recognition of these assets, how to recognize, how to determine their carrying amount and determination of their depreciation charges. And of course, later on we will also see how, if any impairment would take place. So these are the issues which are addressed by this particular standard. So here we go and write the next one. The principal issues as far as principal issues addressed by this standard, that is AS-10 or Ind AS-116. This standard are, what are the principal issues? Are, write A, as I told, recognition of assets, This is one issue. Determination of their carrying amount, of course, determination of their carrying amount. Determination of their carrying amount, this is yet another issue in this particular standard. at what value property, plant and equipment should be carried. Some guidelines will be given, and then determination of depreciation charges, determination of depreciation charges. Then determination of impairment losses, if any, determination of impairment losses, if any. So these are the issues which are addressed by this particular standard, correct? Now logically, when this particular standard should be applied? This standard should be applied in accounting for property, plant and equipment. However, if property, plant and equipment falls under some other standard, in that case this particular standard will not apply. So as a student you need to know this thing also standard. When I say standard, it means either AS-10 or Ind AS 116. A standard should be applied. A standard should be applied in accounting for PPE, except when another standard, except when another AS or another standard requires or permits different treatment. So on such assets, this standard cannot be applied. You will see what type of assets such could be, but later on. Okay, if you want me, I can give the example right now. I know many among you are interested. Why later on? Why not right now? For example, leases, correct? For example, standard on leases, standard on leases requires an enterprise to evaluate its recognition of an item of leased PPE on the basis of transfer of risk. Transfer of risk. And rewards. As we know, under leases, first of all, leases are categorized into financial lease or operating lease. But in case of what we call operating lease, the owner will recognize the asset, whereas in case of what we call financial lease, even the lessee can recognize the asset. Anyway, the point here is that that is part of discussion of what we call when we will go through the standard on leases, but the problem here is that PPE, this particular standard will not apply on PPE leased, you can simply say, correct? So now we come over to the next point, as we normally see that which are the areas where this particular standard will not apply. A standard, that is property, plant and equipment. A standard is not applicable to biological assets. Biological assets related to agricultural activity. Related to agricultural activity. Biological assets could be biological animals or could be biological plant. Biological assets related to agricultural activity this standard will not apply to biological assets which are related to agricultural activity. But here one point I would love to actually clear. As I said, biological assets include biological animals, and plants. Animals and plants. So point here is that this standard is not applicable to biological assets I have written, but this standard will apply to biological plant, correct? Even under biological plant, bearer plant we call it. However, as I write here, however, standard applies to, or standard, okay, I will write standard applies to bearer plant. This standard will apply to bearer plant. Remember one thing, we will talk about bearer plant also, but as the name is suggesting, bearer means it bears fruits, bearer plant. Standard applies to bearer plant. Standard applies to bearer plant, please keep it in your mind. But again, here is a rider. Rider means here is a condition attached that this will apply to bearer plant, but produce on bearer plant will not fall under. Just bearer plant, it will apply to bearer plant, but whatever produce is coming out of that plant, this particular standard will not apply to that particular what we call produce. But standard does not apply to produce on bearer plant. This is the point I want to bring to your notice. Produce on bearer plant. So this standard applies to bearer plant, but it will not apply to what we call any produce on bearer plant, correct? So this is the area which you need to, I hope you have written till up to this particular point. Okay. So a biological asset standard will not apply to biological asset. This particular standard will also not apply to wasting assets like, as we know, mineral rights, expenditure on exploration of what or extraction of mineral oil, natural gas, etc. Correct? B. Wasting assets. Standard will not apply to wasting assets. Including mineral oil, mineral right, you write, mineral right, expenditure on exploration, expenditure on exploration or extraction of minerals, oil, natural gas, or similar non-agricultural, resources. But here one point I would like to bring to your notice, because so often we skip these points. Many a student automatically thinks that whenever the word natural gas or what we call wasting asset will come, PPE will not apply. Remember one thing, if I have used a PPE, let us say to develop or maintain the above asset, then this particular standard will apply. So let me actually write it. However, let me write it with red pen. However, PPE used to develop or maintain aforementioned assets, shall fall under this standard. Under this standard means AS-10 or what we call India's 116. Clear? Okay. Another important point which you need to note, because when you study a standard, especially at this level, you need to have deep, insightful knowledge, as I keep on saying. I have seen actually students neglect these finer points. Superficially they study, but some points which need a little bit of what we call digging, they skip it out. So need to be very clear regarding all these things. As we know, we have studied AS-13 so often, correct? Investment property falls under AS-13. Each one of us is very well aware of it. So investment property as defined in AS-13 investment property as defined in AS-13, correct? In fact, AS-13 revised should be accounted. Investment property definitely falls under AS-13, but it is to be accounted, should be accounted with cost model. We will study later on cost model as prescribed by this standard. That means investment property definitely will fall under what we call AS-13 revised, but as far as its measurement is concerned, that will be done according to this particular standard, and we will see later on, because it is stated that the accounting treatment will be done by following cost model. But what exactly the cost model, we will talk about it later on, correct? Cost model as prescribed in this standard. In this standard. In this standard. So these are the final points which you need to know. Now, we are writing serial wise, so I will take fifth. Fourth was with respect to standard not applicable, but wherein we also saw some finer points, correct? Now, what exactly property, plant and equipment? PPE are, in simple words, tangible items. Correct? These are tangible items. In fact, these are tangible assets, you can say fixed assets, that are generally held for use in the production, or these are meant for what we call supply of goods and services, and we will see, or these are meant for rental. So, property, plant and equipment, property, plant and equipment are tangible, items, that write 1 or write A, are held for use. An enterprise keeps these assets with itself for use in the production or B, supply of goods and services, or you use these what we call assets for supply of goods and services, for example, transport vehicles, supply of goods and services, goods or services, or C, for rentals, for administrative purposes, for rental for administrative purposes. Actually, problem is this word administrative purpose. For rental is easy to comprehend, but for rental for administrative purposes, what does mean? See here. Actually, word administrative purpose is not clearly defined in this particular standard, but let me actually complete the definition of PPE. So PPE are tangible assets which are held for use in production or supply of goods or for rental. Generally, we call it for administrative purpose, and expected to be used for a period exceeding 12 months. Exceeding 12 months. Now I was talking about administrative purpose. The meaning of administrative purpose you need to comprehend quite well. Administrative purpose administrative purpose administrative purpose will include, when even though we are saying administrative purpose, but it implies a selling and distribution, selling and distribution, it includes finance and accounting, if we have let out a computer or a digital machine, so it can be used for finance and accounting purpose. C, personnel and other function. Point here is to be noted that administrative purpose is not simply confined to the general meaning of administration. So it includes basically selling, distribution, and finance and accounting, and for any other function, to be honest with you. So you need to be very careful with respect to what we call definition of PPE, because especially this last C1 sometime actually gives us a bit of problem. Now here, some important point I would like to bring to your notice, as we have a habit, as I keep on saying, that we have to dig deep. Note, very important point. See here, what I'm trying to make you right. Items of PPE sometimes we acquire to satisfy or comply with the norms of the what we call environmental issues. Even such PPE will be considered, will fall under this particular standard. Items of PPE. Items of PPE acquired for safety or environmental reasons should be accounted under this standard. What does it mean? At this level, sometimes questions or case studies are asked even with respect to such finer point which we generally tend to skip out. Correct? So, quite obviously, I will make you understand with an example down over here. Okay, let me write the example. Correct? A chemical manufacturer, a chemical manufacturer installs. So there is an entity which is manufacturing, you can say, chemicals, quite a hazardous what we call production. So a chemical manufacturer installs a new chemical handling process correct to comply with environmental safety norms. Environmental safety norms. Correct? Environmental safety norms for production and storage of harmful and dangerous chemicals. So because this chemical handling process means a new plant, correct? This new plant has been actually installed. Why it has been installed? Because we want to comply with the what we call environmental safety programs. So here, in this case, this new plant will be what we call part of, will fall under what we call this standard. New plant, that is new chemical process. New plant enhancement or items shall be considered PPE and this standard shall apply. This standard shall apply means India AS-16 or AS-10. Shall apply. Is it clear to you? Right. Just a moment ago, I was talking with respect to what we call biological asset. Let me clear it once again. Correct? This was our point number because I want to carry along with the points. Correct? Point number 6. Biological assets. We know that biological asset means biological. Where is the scale? I'm not able to search it. Anyway, I will take this one. We know that biological asset is either an animal or plant. Correct? We have already talked about this. Biological asset happens to be animal, biological animal, or plant. And I told you, if the plant is a bearer plant, then it will fall under this standard. Bearer plant will fall under this standard. Now, what is a bearer plant? Bearer plant is one which satisfies which satisfies all the undermentioned three conditions. So three criterias are there. If those criterias or conditions are met, then only it will be considered as bearer plant. Condition 1 is used in production or supply, is used in production or supply of agricultural produce. Such plant must have been used either in production or supply of agricultural produce. Agricultural produce will not fall under this standard. You must understand this. Only I am talking about bearer plant. A bearer plant is one which is used either in production or supply of agricultural produce. That is used in production of agricultural produce or supply of agricultural produce. Correct? Then is expected to bear produce for a period of more than 12 months. And in simple words, its life must be more than 12 years. Must be 12 months, must be more than 12 months. And third, has a remote chance of being sold as agricultural produce. If all these conditions, all these criteria shall be met, then only it can be considered as bearer plant. I will try to actually make you understand. Now just pay attention. And you know, regarding my drawing, the less I will say, the better it is, isn't it? And but still I will try to draw a drawing before you. And please don't laugh. This is the only problem with me. And I'm drawing before you, let us say, a tree. Yes. Correct. And let us say, what should I draw now? The problem is this. I hope now it is looking like a tree. I hope you are not laughing now. Sir, please tell us the name of the tree. Oh my God. Just wait. Wait. Let me draw, let me complete. Lot of patience is required. Anyway, let us say this tree is a coconut tree, okay? Because it is a coconut tree, of course, it is a bearer plant. It is a bearer plant, no doubt about that. And the agricultural produce what will be the produce of this bearer plant? It happens to be a coconut tree. Of course, coconuts. I do not know whether I have spelled it correctly or not. Please don't laugh. Correct? So, as far as fauna is considered, I have very, very less what we call knowledge regarding that. But anyway, so bearer plant, and bearer plant, I have considered it as a coconut tree, so agricultural produce is coconuts. And now my point is, see here, if this bearer plant, an entity has a what we call bearer plant, let us say, it produces what we call coconuts. Now the point here is that we can say this bearer plant is being used for production of coconuts, correct? Or let us say this entity is using this bearer plant, correct? This is a bearer plant, and we are using this particular production for supply, let us say this bearer plant which we have got, it is producing what we call coconuts, and coconuts we might be using, we might be selling, but coconuts, the agricultural produce, will not fall under this particular standard. Similarly, this production we might be what we call supplying somewhere else. So point here is to be noted that agricultural produce will not fall under what we call this standard. Only bearer plant, because it is fetching us some return in some or other way around, will be considered. And rest I have already told you. It should just wait for a while. Then I have already told you that its life should be more than 12 months. And last I wrote, there should be very slim chances, remote chance of being sold as agricultural produce. That means this bearer plant, we are not going to sell this bearer plant. We can sell the produce, we can supply the produce, but we cannot sell this entire plant. There are very remote chance. Remote means absolutely insignificant chance. So three conditions: we are using it for production or supply, its life is more than 12 months, and there is virtually no chance of selling the entire tree itself. However, let us say this particular plant has gone past its life. Let us say now 20 years have gone by and this plant has become virtually useless for us. Now we may sell it as an incidental scrap sales, then that's a different matter. But generally, there is no chance what we call for the entire plant to be sold out as it is. So all these three conditions must be satisfied before we can what we call it as a bearer plant. So these are the points which I just wanted to put forward in the first session. We are moving over to recognition criteria. So recognition, this is point number 7. I have seen many a student again have a very hazy idea regarding the word recognition criteria. Regarding recognition, what is recognition? Recognition means whether you want to show this expenditure as an asset or not. That means, first of all, the entity will decide whether this expenditure which we have incurred should be what we call considered as an asset for us or not. So an entity decides to recognize an expenditure as an asset only when it feels that this expenditure probably would fetch them what we call future benefits, and secondly, the cost can be measured reliably. So right here, sorry, extremely. There are two conditions. A, it is probable that future economic benefits FEB, future economic benefits associated with the item shall flow to the enterprise, so enterprise should be assured of it. Enterprise, and as I said, cost can be measured reliably. Cost of the item can be measured reliably, correct? So these are the two criteria. If we have incurred an expenditure, of course, upon a particular item, then that item can be recognized as PPE if both these criteria are satisfied, correct? Once we have decided that we are going to account this item as a PPE, of course, the next question which will be confronted by us will be how to measure it. At what value? It should be what we call reflected in the books. As you know better than I, actually there are two types of recording. One is initial and later one, of course, subsequent. So, as far as measurement part is concerned, measurement of PPE. Measurement of PPE. Just allow me a minute, actually there is an urgent call. Hello? Bolo? Are bolo? Bolo na, jaldi bolo. 2-3 हजार? 2-3 हाँ हाँ मैंने दिया बिजली का बिल दिया था हाँ 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 दिया ये तो कोई फोन मत रखा ये रिकॉर्डिंग चल रही होती है Extremely sorry. Sometimes this calls actually puts a little bit of problem, and you might be wondering then why I'm not switching it off. Problem is that here in Delhi, the situation nowadays, you might be hearing on TVs and all, is not quite well, correct? But still I have come to the office when the staff is absent. Problem is this. There are violence, riots, everything going on, and that is the problem. And there are some calls which we have to pick up, we simply can't ignore because examinations of some bodies are still on. So that's the reason. I hope you'll bear with me. So measurement of PPE. So recognition of PPE as far as is concerned, I told you that As far as measurement is concerned, in simple words, means what value we should assign. Generally, when we are going to acquire the asset, at what value we are going to actually recognize that particular PPE, that is the point, and that is known as initial recording. Then later on we will see the issues with respect to subsequent recording. Correct? So, as far as recognition is concerned, it is quite simple. A, initial recording is done at cost. Initial recognition. Initially, PPE shall be recognized at cost without any doubt. And subsequently, we have a choice. Subsequently, we can follow cost model, subsequent recognition, we can follow cost or revaluation model. We will see it later on what exactly this cost or revaluation model. That means an entity has a choice, either it can go for cost model or it can go for revaluation model subsequently. But first we shall talk about initial recognition. So next point is initial recognition. That is initial. I have already told you initial recognition will be done at cost. And it means actually we need to know quite well the meaning of cost. Initial recognition. Initially we are going to recognize the PPE at cost. But what cost means? Cost of PPE includes a scale is where I have lost the scale and I need that. Anyway, I will pick up some pen here. I will try to put it in a diagrammatic manner. We can divide the cost into these elements. A, purchase price, B, that is directly attributable cost, directly attributable cost. Besides that, this standard has given third type of cost also, that is decommissioning, DECOMM, ISSIONING, decommissioning cost. Decommissioning or restoration cost. We will talk about all this. But what is purchase price? Purchase price shall include import duties, non-refundable taxes, etc. Any trade discount or rebates allowed shall be subtracted. Suppose when we purchase the quantity and the volume is very high, we get what we call rebate or trade discount, then it will be subtracted, shall be subtracted. Then directly attributable cost mean any cost which entity incurs in bringing the what we call that asset to its necessary condition or location. Any cost directly attributable in bringing the asset to its present location and condition necessary for it to be capable of operating in the manner as intended by the management. If you have incurred any cost and that cost can be attributed to the said asset, correct? And that cost has been incurred in bringing that asset to the present location and putting them into a sort of condition which the management aspires for, that means which the management wishing for, so that it becomes capable in operating in a manner which is intended by the management, means you are putting that cost to bring the asset into a such what we call formation that it works almost as wished by what we call or as aspired by the management. Correct? Generally such cost will include, now I will have to use the next sheet, correct? So this is under point number 2. Examples of such cost can be directly attributable cost. Examples, for example, cost of preparation, cost of site preparation. Second, initial delivery and handling charges. and handling charges. Handling charges. Then third, right installation and assembly cost. Assembling cost, you write. Testing cost. Sometimes we test whether this PPE is working in the condition or it is capable of working in the condition as aspired by the management or as wished by the management. And generally, sometimes when we do tests, during such situation, there could be a possibility that, let us say an entity is testing a machine and some production comes out and we sell that production. So testing cost will reduce by the sale price of that production. So that is why I am going to write here net proceeds. That means under testing cost, you will take the net amount, net proceeds after subtracting related income, any related income. Right professional fee. So generally these costs fall under what we call directly attributable cost. Besides that, we have decommissioning or restoration cost. Under it there are no particular cost, so I'm not going to write it separately. We shall talk about what we call all these things, but before that let me make it also clear that there are some costs which are not considered. There are some costs which are not considered. Following costs, and this is very vital, I'm telling you time and again, there is no point in doing mere superficial study and ignoring the finer points. Most of us lose patience when we do the finer points. That is the problem. So it is very important for you to keep your patience level very high, go through each and every point. Following costs are not included. Not included in the carrying amount of PPE. You are not going to include these costs. Carrying amount of PPE. And this is a very vital topic. So often in the questions or case studies later on we will see that a solution could go haywire if we do not what we call have sufficient what we call knowledge with respect to these points. A, cost incurred while item is capable of operating as per desired intentions of the management of the management but has not been brought to use or is operated at less than full capacity. Try to understand this. Let us say some cost has been incurred and plant is almost ready and it is capable of being used as per the desired intention. But that plant or that item hasn't been brought to use. Or even if it is brought to use, it is not brought to use to its full capacity. So, in simple words, when an item of PPE is not brought to use to its full capacity, any cost incurred prior to it will not be capitalized, will not be included in the carrying amount, means will not be capitalized, it will be expensed, correct? So this is a final point which you need to understand. Similarly, you write here B, that is why I keep on saying everyone does superficial points. It is important to dig deep. Costs of conducting business in a new location or with a new class of customers. So cost of conducting a new business. If we are conducting a new business, we cannot include that cost in the carrying amount of this particular PPE. Correct? That is the point. C. Cost of introducing a new product or service including advertising and promotional activities. So if your PPE can be used to produce another item, then cost of introducing that item and any cost incurred on its advertising or promotional activity will not be included under what we call PPE of that item, of course. Then similarly, administrative and other general costs So regarding cost, you have to be very, very clear. We are talking about what we call initial recognition. Correct? So as far as initial recognition is concerned, by now you are very well familiar that which type of cost is included and which type of cost need to be excluded. Quite obviously, it will lead us to some case studies. Correct? So we will pick up some case study. Case study 2. We did one case study earlier, I think. Right here. Z India acquired a machinery for rupees 50 lakhs. And paid freight cost of rupees 1 lakh, professional fee rupees 2 lakhs, and and rupees 3 lakhs on removal of existing machinery and preparation of proper foundations for new machine. Company also spent rupees 4 lakhs on trial run during trial runs some products manufactured that were sold for rupees 1 lakh. Just a minute ago I told you regarding this point. If during testing, if we sell any material then it will reduce the testing cost, correct? Now my point is compute the acquisition cost. So when you acquire the machinery, what is the cost? Compute acquisition cost. Correct? Simple, you should be in a position to deliver the answer to this question. Correct? As we know, now here is the solution. Computation of cost of PPE, so purchase price. Purchase price is 50 lakhs, correct? Freight. Freight we have incurred 1 lakh. Directly attributable cost. Professional fee. Directly attributable cost 2 lakh. Now whatever cost you incurred in removing the old machinery and preparing the site or foundation for the new machinery will be part, no doubt about that. So removal and preparation cost preparation of foundations, correct? That was 3 lakhs. Then testing cost. You incurred a cost of 4 lakh. During the testing, some products got manufactured. You sold them out for 1 lakh. So only net proceed, net cost will be taken into account. So this will become cost of PPE. That will be equal to 6, 8, 9, 59 lakhs. This will become the cost of what we call this particular asset. Now we take case study 3. Under this case study, write V7 Limited, comma, on 1/4/2021 installed a machine in rented premises. Rented premises. Rented premises at a cost of rupees 50 lakhs. Life of the machine is estimated of 3 years. quite short life anyway. As per the agreement, comma, machine should be. Now there was agreement, as per the agreement, because we took a rented premises wherein we are installing this machine. So as per the agreement with the landlord, it means machine should be decommissioned. I hope now you got the meaning of decommissioned. Decommissioned. When you are installing the machine, it is known as commissioned. And when you will take away your machinery, it will be known as decommissioned. So your landlord is telling you that you will have to decommission your machine from here, of course. As per the agreement, machine should be decommissioned and buildings should be brought to its original position. That is nothing but restoration cost. Buildings should be brought to original position. What does it mean? Landlord tells us that you are installing a machine here. After 3 years, correct, you should decommission it. Besides, because when you are installing, quite obviously my building will get bit of what we call damaged. So you will have to restore it. You will have to bring it to the original position, means you have to restore it. So often entities have to incur cost on decommissioning, because when I am going to actually take away the machinery, again I will have to incur some cost, and of course putting the building into what we call its original position, again I will have to incur cost. This particular cost is restoration cost. So decommissioning or restoration cost, remember one thing, is should be included in the cost of what we call carrying amount of PPE. Original position, correct. Also write, okay, this sheet is over. I will use the next sheet now. V7 Limited estimates that the decommissioning and restoration cost would amount to or will amount to rupees 5 lakh. So they made an estimate and thought that near about 5 lakh we shall have to spend in decommissioning and restoration of building, of course, correct? Assume borrowing rate is 10% per annum. Question against is again the same, compute acquisition cost. So what will be acquisition cost in this case now? It is very important. See here, before we solve this question, here I am writing solution, but try to understand this point. Let us say we are acquiring the machinery on this date, 1/4/2021, correct? Let us say first year will fall somewhere here, 31/3/2022, first year end. Second year end, let us say 31/3/23 will fall here. And now 31/3/24, that is the third year. We are acquiring the machinery here. We are acquiring the machinery here. Try to understand this point. No doubt we have acquired it for 50 lakhs. So I will write here purchase price 50 lakhs. On this date, I will have to estimate the cost of this asset. Now, my point is, I will definitely take into account decommissioning and restoration cost. I will definitely take that into account. But what will be my amount? Because we have to decommission. Decommissioning will take place at year 3, at the end of year 3, in fact, sorry. Here the decommissioning cost and restoration cost I will have to incur. I'm not incurring decommissioning cost and restoration cost here. Try to understand this point. There is an agreement that the commissioned machinery will have to be decommissioned and building will have to be actually put into its original position. So, point here is that, and I have made an estimate that I will have to churn out nearly 5 lakh rupees on decommissioning and of course on restoration. So, I have to find here the value of 5 lakh. For that we use discounting technique. See here what my point is. Present value factor of 10%, you have done it so many times in your financial management, for 3 years. That is equal to 0.751. 0.751. This is the discount factor at 10% because in the question we have included borrowing cost. Borrowing cost means what we call market rate of interest. So at 10% for 3 years, this is 0.71. So actually this amount I am going to spend after 3 years. First of all, what does this 0.751 states? It states that 1 rupee which is in your hand today, after 3 years, it is equal to 0.751. And I'm going to spend 5 lakh after 3 years. What is its real worth today? So, see here, 5 lakh into 0.751. It will be equal to some 3,75,500. It means 5 lakh I am going to spend after 3 years. After 3 years. So value of 5 lakh after 3 years actually is 3,75,500 only. So that is why we have to discount it. All in all, we have to take into account decommissioning cost, and as far as possible we should try to discount them. At discounted value, it is known also as cash equivalent. It is also known as cash equivalent. Remember one thing. Anyway, so this will be, initially, I will feel that this is the cost of this particular asset, 53,75,500. Correct? Is it clear to you? Of course, in the upcoming session, we will have something more to discuss regarding this particular. We'll do lots of case studies because from initial recognition, so often questions have been asked even in the past. So as I said, we have to pick up some more what we call case studies. So we will pick up another one in this particular session, which was the last case study which we did. I just want to actually confirm the serial numbering. So case study 4 now it is. Case study 4. All these case studies are generally related to what we call acquisition cost determination. Correct? When we acquire the asset, at what value we have to recognize the same. Right. In this case study, R89, that is the name of the company. R89 Limited is installing just now it's okay, is installing a new machinery it provides following information. Cost of plant let us say 34,25,000. 34,25,000, this is the cost of the plant. Correct? Then dismantling cost to be incurred after 5 years. Logically, it is nothing but decommissioning cost, and it is given to you, that is 2,50,000. But this time we cannot compute what we call its present value, because we will see later on that here no discount rate is given, and we will presume that it is the discounted value. Correct? Third, initial operating losses before commercial production. Now this cost will not be taken into account. Reason, I told you, unless and until the plant will function at full capacity and start producing what we call commercially, so any cost incurred prior to that will not form part of the what we call carry cost. So we are not going to consider this one. 3,75,000, this cost will not be taken into account. Correct? Let us say initial delivery and handling cost, it will be considered as a part of cost, no doubt about that. Cost of site preparation, it will be considered while computing the cost, no doubt about that. So site preparation cost, this is 4,50,000. Then consultant used for advice on acquired plant. Quite obviously, you are going to take this cost. Let us say it is 6,50,000. So question is, advise the company regarding costs to be capitalized. Although you need to show the complete solution, correct? You need to show the complete cost statement, cost of plant 3425, dismantling 250, but I am simply writing except, this is the solution, except where that cost has gone, except point number 3, all costs shall be capitalized. You got my point or not? Shall be capitalized. So simple. So this way we have saved the time. So point number 3 will not be considered, and rest of the cost will be added to find out the cost of acquisition. Correct? So this is what we call case study 4. We pick up a very interesting case study now, case study 5. Case study 5. Right here, F4 Limited, contracted with a supplier to purchase a specific machinery, machine to be stored in Department A, in 2 months' time. Or in 2 months. Full stop. Right. Special foundations. Special foundations special foundations are required or were required, you write, were required for the new plant or machinery, whatever it is, sheet adjustment. It is creating problem. I hope it is flashing on your screens, correct? Special foundations were required for the new plant, which were to be prepared within the supply lead time. It means within 2 months. Why? Because here it is written 2 months. That is the lead time. Correct? Right then, cost of site preparation, cost of site preparation and laying foundations why this is not flashing correctly. Just wait. Give me a minute. Actually, I'm feeling uneasy because of this it seems adjustment has gone haywire. Just let me check it out. Right. Cost of site preparation and laying foundation were rupees 47,290. These activities were carried out. These activities were supervised by a technician who is employed for this purpose at a salary of rupees 15,000 per month. 15,000 per month. Correct? Then also write technicians services were actually to Department B. Actually to Department B. And they built BILLED, and they build services at rupees 16,500. At rupees 16,500. Per month, of course, after adding. Actually, this line is to confuse. I will explain it later on. Adding 10% margin. Machine was purchased for rupees 52,78,000. Full stop. GST applicable at 4%. Correct? GST applicable is 4%. Clear? Also write transportation charges. Transportation charges amounted to rupees 18,500. 18,500. Correct? An architect was also engaged and simply write at a fee of rupees 10,000 of course to supervise, for supervision purpose or for site preparation purpose, whatever it is. Also, comma, payment under just wait, sometime this pen creates problem. Also, payment under the invoice was due in 3 months' time. Sometimes it is very difficult to memorize such a long question, but still I have tried to be as close to the original one Correct? You might be wondering, people down sitting here are saying, well, 3 months. However, company made payment. Last 2-3 lines are simply meant for creating confusion. However, company made payment in second month. Let me add one more. Company operates on a bank overdraft at the rate of whatever it is, 11% per month. Per annum, you write. Per annum. I will explain each and every aspect. Don't worry about it, sign. Correct? F4 Limited contracted with the supplier that please send us a machine. And that machine need to be put in Department A. This company is having 2 departments. One is Department A, another one is Department B. Initially, question states that a special foundation are required for the new plant, which were to be prepared within the lead time. Lead time, of course, means 2 months because we have to install it within 2 months. Now, we will take into account all the cost, but see here, machine was purchased for 52,78,000. It is written here. Correct? So we begin with purchase price. First of all, it is always better. So right, this is the solution now. Purchase price this pen is giving problem. Just wait. Let me pick up this one. Purchase price is 52,78,000. That is given to us, 52,78,000. It is also given to us below the purchase price that GST applicable is 4% added. GST 4% of 52,78, that will be equal to how much? 211, figuratively, yes, 120. Accept it. Then also written transportation charges, so we shall add it. Transportation charges. Transportation charges are 18,500. 18,500. 18,500 I have written? Right. 18,500. Then besides that, it is given below also that architect was also employed. So architect. Architect fee. Architect fees given to you is 10,000, so we shall add 10,000. Now this is not going to make any difference that we have employed the architect and we are supposed to make the payment, what we call all these payment, in fact, was due in 3 months and we paid it within 2 months. It is not going to matter. Important is that this is the cost, what we call, which we are supposed to capitalize, whether we have incurred it or not. Correct? Then, before that, we have been given earlier cost of site preparation. So, cost of site preparation. Cost of site preparation. Cost of site preparation is how much? Cost of site preparation is 47,290. Then we have been given that these activities were supervised by a technician. Now, don't get confused by this line that technician services were actually for Department B. No doubt, it means actually that technician was actually hired by Department B. Since machinery has to be installed in Department A, so Department A told what we call Department B, please actually allow these technicians to work here for 2 months. So Department B is billing us. They bill the amount, instead of 15,000, they bill the amount for 16,500 by adding 10% margin. 15,000 plus 10%, 1,500 is 16,500. But as you know, each one of us each one of us has done actually departmental accounts at our some or other point of what we call time. Now, it is a case of interdepartmental transaction, and as far as interdepartmental transactions are concerned, profit margins are excluded. So that is why we will take into account only 15,000 and profit margins will not be considered. So cost of site preparation, after that I am going to write technician's salary. Technician's salary. Actually 15,000 per month into 2, 30,000. Then we have taken all the other expenses. So this will be your cost. I will need a calculator because people down here will take a lot of time. So fortunately I got the calculator, and let me now add it. 52,78,000 plus 2,11,120, right, plus 18,500 plus 10,000 plus 47,290 and plus 30,000. So this is 55,94,910. Now please pay attention here. We haven't taken into account this point. Company operates on a bank overdraft. Now it means whatever payment we are making, so we are taking a bank overdraft. It is almost like taking a loan and then we are making a payment. Are you getting my point? So quite obviously, because these payments are for 2 months, quite obviously, it means I am taking a loan for 2 months to make these payments. That is the point of, that is the meaning of this particular line. So logically, if we are going to think, obviously during these 2 months period, I will have to pay some interest because I am taking a loan to make the payment for 2 months. So 2 months interest is there, no doubt. It is also a cost, but it will not be considered as the cost carrying, it will not be considered as a part of carrying cost of this particular asset. I will write here. But before that, let me explain also the point I was talking about, technician salary. See here, just for understanding. There is Department B, there is Department A. And this technician is actually employed by B. And as I said, machine is being installed in Department A, so Department A might have asked Department B to allow your technician to work here. Okay, he worked here. And then Department B actually billed the services at 15,000 plus 10% margin. Department B billed the amount as 16,500 per month. That means Department B is taking a margin from Department A. But as I said, in case of interdepartmental transaction, we are not going to consider the what we call margin. So we have taken 15,000 only. So interdepartmental margins are not taken into account. Interdepartmental margins. Interdepartmental margins shall not be taken into account. Or shall not be considered. Similarly, interest on bank overdraft, for 2 months. That means this is the interest cost. Interest on bank overdraft for 2 months shall also not be considered. It will not be considered. It will not be considered while computing carrying amount or cost acquisition cost or carrying amount of what we call this particular asset. However, it is a cost which will be expensed. So these are the points what we call in this particular question. As I said, it's an interesting one. So we have done case study, which was this one. I always forget the numbering. So 5 case study. This one was pretty long one, but interesting one, isn't it or not? So now we take up, after case study 5, we now take case study 6. Correct? We now take case study 6. Now, in this case study, allow me a minute or so to think. Okay, right. Entity A supermarket chain. Supermarket chain is renovating one of its major plants, one of its major stores, you write. The store will have more available space for promotional outlets and will include a restaurant. So entity A is a supermarket chain and it is renovating one of its major stores. once the renovation work will be over, the store will have lots of space to carry out their promotional outlets, promotional activities, and not only that, they will also have some, you can say, eating facilities, because it will also include a restaurant. Correct? Management is preparing the budget for the year after a store reopens. So management is trying to make an estimate that what will happen once the store will open after a store reopens. Which include cost of remodeling, and expectations of 15% increase in sales, resulting from store renovation. State whether remodeling cost should be capitalized or not. That is the question. Even though question is very, very long. Correct? Honestly speaking, not tough. Entity is interested in what we call simply, in fact, entity is renovating one of major stores, and the management is of the view that once the store will reopen, and this remodeling cost, after taking into account this remodeling cost, there will be increment in sales volume by 15%. So, what's your take on it? Any expenditure, honestly speaking, which will enhance the future economic benefit must be capitalized. Simple rule is that. So on that basis, we may say, yes, this cost can be capitalized. Solution. The expenditure on remodeling the store will create future economic benefits and the cost can also be measured reliably. So, once we are very sure that it is going to create future economic benefits and the cost can be measured reliably, then we should not have any doubt that it can be recognized as an asset. Therefore, it should be capitalized. It should be capitalized. Correct? So these or such type of case studies are vital because otherwise they may create problem if they strike in the examination. Correct? Now we pick up case study 7. This was 6. This was 6th or 7th, which we did earlier. Just let me see. We have done 4, then where is the 5? Or numbering mistake, 4, 5, 6, right. Now this is 7th. Now in this case study, just give me a minute or so. Reason being is that I have to recap the things that now what point I need to bring to your foray. Point is this. Okay, right now, entity PXM, this is the name, has an existing freehold property. Freehold property has an existing freehold property which it intends to knock down, and redevelop the same, or simply redevelop. So that is the intention of knocking it down. During the redevelopment period, the company will move its production So company basically is interested in, as I said, knocking down one of its freehold property and want to redevelop the same. And during this redevelopmental stage, the company will move its production facility, let's say, to some another site. Production facility uh, production facilities to another that means temporarily we are going to take the production facility to some another site. Correct? The following incremental costs will be incurred. Following incremental cost will be incurred. Right, 1. Setup cost of rupees 5 lakhs to install the machinery in the new location, of course. Then, because we have taken the site to the new location, let's say another cost is rent. Rent of rupees 15 lakhs. Because we have temporarily shifted. Obviously, we might have shifted to a site which is rented. Correct? 15 lakhs. Removal cost. Of course, we have to take all the plant and machinery, we have to remove them from present place to the temporary site. Removal cost of rupees 3 lakhs to transport machinery from old location to temporary location. Can these costs be capitalized into the cost of new building, because we are redeveloping the freehold property. So instead of saying new plant, we have used the word new building. Pay attention, it's not an easy to answer, this one. Constructing constructing or acquiring a new asset may result incremental costs that would have been avoided if, that means we would not have incurred these costs if construction or acquisition had not taken place. So constructing or acquiring a new asset may result incremental cost that would have been avoided if asset had not been constructed or acquired. That is what we mean by incremental cost. Or acquired. Such costs are not to be included in the cost of asset if they are not directly attributable to bringing the asset to the location and condition necessary for it to be capable of operating in a manner as desired by the management. Desired by the management. In the present case, costs to be incurred by the company are in the nature of I will lead a new sheet, in the nature of, just wait, let me settle down the sheets here. These sheets sometimes create lots of problems. Right. Now it is okay. In the nature of, what I wrote, what sentence? In the present case, costs to be incurred by the company are in the nature of, right. I do not know why today there is a problem. Cost, in the nature of costs of relocating, because we are moving out from one place to another, cost of relocating, correct, or reorganizing, of operations of the company and do not meet what? The requirements of the standard. Do not meet the requirement of the standard. Pretty long answer, can't help it. And therefore, cannot be capitalized. So there are some costs which an entity incurs, no doubt about that, but such cost could have been avoided if no construction activity would have taken place, or we wouldn't have what we call acquired the asset, correct? Further, such costs can be capitalized only if they are directly attributable to the what we call said asset. But in this case, these are the costs in the nature of relocation, correct, or reorganization, so they cannot be capitalized. This is the important point which we need to take care of in this particular what we call part. Get ready for another case study. Lots of case study we need to do, as you know, and we have a habit of doing lots of. So here we go, take up case study 10th. Sorry, case study 7 we have done. So we take 8th one. Correct? In this case study, well, allow me a minute, just let me recap. Right, enough. An amusement park has a soft opening. Soft opening is trial opening. Very soft opening to the general public or to the public. to trial run its attractions. So we want to put ourselves before the public. We are trying to actually give us attractive views. Come to this park, we have got lots of attractions. Tickets are sold at 50% discount during this period, and operating capacity is 80%. That means we are not functioning at our full capacity. Do you remember? This was the point I initially brought to your notice. Operating capacity is 80%. The officials the official opening date or opening day of amusement park is 3 months later. So after 3 months, officially this park will get open to the public. Management claim that soft opening is a trial run necessary for amusement park to be in the condition capable of operating in the intended manner. So management is claiming that this soft opening is necessary to know whether it will operate as per the desired, what we call desired lines or not. So accordingly, what management did, so accordingly, comma, the net operating cost incurred should be capitalized. This is the view of the management. Should be capitalized. But we know any cost incurred before the what we call plant comes into its 100% capacity should not be capitalized. Management thinks that it should be capitalized. Comment. I have already given you the answer. The net operating cost, that means cost minus some revenue which might have accrued to us during the trial phase, net operating cost should not be capitalized. It should not be capitalized. Rather, should be recognized in a statement of P&L. Recognized in a statement of profit and loss account. Correct? Even though it is running at less than full capacity, yet commercial production, commercially it is yet to operate. So that is the reason we cannot capitalize what we call these costs. Is it clear to you? So these are the case studies which are related to your what we call initial recognition of the PPE or simply a determination of acquisition cost. Correct? We will take up some more issues with respect to this particular standard. It happens to be a pretty long standard, no doubt about that. Last time, point number 9 we had written. Now we will move further. Write spare parts right. Spare parts standby and servicing equipment. Servicing equipment. What will be the treatment of spare parts, standby and servicing equipment? If such items meet the definition of PPE property, plant and equipment, then such items should be treated as PPE as per this standard, that is AS-10 or Ind AS and Ind AS 16. However, if these items do not meet the definition of PPE, then these items should be treated as inventory, in accordance with AS-2 or Ind AS-2. Correct? Obviously, you will like to have a case study even with respect to this. Last time case study we did 8, so this is case study 9. In this case study, write P4 Limited acquired a standby generator during current year for rupees 100 lakhs and servicing equipment for rupees 10 lakhs. P4 wants to capitalize these assets as PPE. So entity is interested in recognizing these assets as PPE. What is your take? We have already seen that spare parts, standby and servicing equipment should be treated as PPE only if they satisfy the definition of PPE. So what will be our response? You write PPE, first you write the definition. PPE are tangible assets tangible items or assets that A are held for use in production, or B for supply of goods and services or C for rental to others for administrative purposes. And can be used and are expected to be used for a period of 12 months or more. So this is the definition of PPE. Now standby generator definitely and servicing equipment, correct? They can satisfy this criteria, so can be capitalized. Since these assets can satisfy the definition of PPE, the definition of PPE they can be recognized as PPE. So this is with respect to spare parts, standby and servicing, what we call equipment, correct? Now we move over to an important area, that is PPE acquired in exchange sometime we give our asset and acquire a new one. Now, what happens under these circumstances? Correct? In order to make you understand the accounting treatment under this, we will take directly some case studies. No doubt about that. We will directly take some case studies so that it becomes what we call easily comprehensible to you. Correct? But before we dwell upon that, you just allow me 2 minutes. 2 minutes only. I will have my tea, or you can say 3 minutes, then I will continue with that. Well then, we come directly to the point, and sorry to make you wait for a while. So PPE acquired in exchange, what does it mean and what will be the accounting treatment? You will be able to understand it only when we will do a case study. Let me write one, then I will explain it. This is case study 10. To understand this topic, we directly take a case study, correct? Entity F9 exchanges surplus land with rupees 10 lakhs in cash and for rupees okay, I will change this because it will not allow me a minute please. Some entity F9 exchanges surplus land, cut it down. Surplus land with book value of rupees 10 lakhs, with book value of rupees 10 lakhs for cash of rupees 20 lakhs and plant and machinery valued at rupees 25 lakhs. What will be the measurement? What will be the measurement cost of assets acquired or assets received? Assets received. This is the question. Let me actually clarify the question first. Correct? This is entity F9. It has surplus land. And book value is 10 lakh. Book value is 10 lakh. It exchanges this land and gets, F9 receives cash, it receives one cash worth rupees 20 lakhs. Besides, it also receives plant and machinery. We may say that this property, plant and equipment has been exchanged against some monetary and non-monetary assets. Correct? And plant and machinery is valued at 25 lakhs. First of all, you let me know, how could you get 45 lakhs worth of benefits when your land book value is 10 lakh? Obviously, it means you need to infer it this way. You have to infer it this way, that its fair value must be 45 lakhs. The fair value of your land must be equal to 45 lakh. Then only you can get 45 lakh for your land. Now, as far as accounting treatment is concerned, how the accounting treatment will be done? See here. First of all, see whether this transaction has commercial substance or not. Transaction has commercial substance or not. What does it mean? I will write here transaction has commercial substance. How did I figure it out? transaction has commercial substance. How can I infer it? That means in case of exchange, we need to find out whether the transaction has commercial substance or not. How will you determine it? See here. You simply let me know what worth of amount is moving out. Worth moving out. Worth moving out is 10 lakh because book value of your land is 10 lakh. This much worth of land is going out. You are losing from your balance sheet an item or an asset whose carrying amount was 10 lakh. So worth moving out is 10 lakh. Worth moving in, but what you are getting in? You are getting in 45 lakhs. In case of exchange, transaction has commercial substance when there is a difference between what we call these two. Are you getting my point or not? So we may say that this particular transaction has commercial substance. In case of exchange, if the transaction will have commercial substance means differences in inflow and outflow, correct? So if the transaction will have commercial substance, in that case, what will be the treatment? Logically, in this case, this is your response. Since transaction has commercial substance, since transaction has commercial substance, assets acquired shall be recorded at fair value. If commercial substance is there, then assets acquired shall be recorded at fair value. What will be entries in the books of F9? Entry number 1, land account debit. Two, revaluation reserve account or statement of P&L, because the value of land has gone up from 10 lakh to 45 lakhs, so 35 lakh worth of gain is there. All figures are in lakhs, correct? Then it has acquired two assets, one in the form of cash, another one in the form of machinery or plant, whatever it is, correct? $10 lakh value of land has gone up to 45 lakh. This is the fair value of the land. So 45 lakh worth of land is moving out, number one. And you are receiving a cash of 10 lakh. So out of 10 lakh, out of this fair value 45 lakh, if we are going to subtract 10 lakh, so we can conclude fair value of plant and machinery is 25 lakh. This is how we are going to record the entry. Are you getting my point? So whenever assets would be exchanged, we have to see whether there is commercial substance or not. I will give you another example. This was case study 10, now case study 11. Right here. Entity T5 exchanges car X with book value of rupees 13 lakhs and fair value of 13,25,000. Entity T5 exchanges car X with book value of 13 lakh and fair value of 13,25,000. Correct? For cash of rupees 15,000 and car Y which has fair value of rupees 13,10,000. 13,10,000. Difference between this question and the question which I did earlier, at that time I wrote land appearing in the books at 10 lakh, but I did not write that its fair value is this much or so much. Are you getting my point? But here I have written that the asset is having a book value of 30 lakh and it is having a fair value of 13 lakh 25,000 and it is exchanged against cash of 15,000 and car Y with a fair value of 13 lakh 10,000. So you have to keep that into your account, correct? Let's come to the point. Entity T5 is having a car X and given its book value is 13 lakhs, but it is also given its fair value is 13 lakh 25,000, which was not given in the last question, correct? And we are exchanging this car for cash. We are receiving a cash of 15,000 and we are receiving car Y of 13 lakh 10,000. Now pay attention. Try to find out whether there is commercial substance or not. Commercial substance. For that, you need to find out worth going out. How much worth is going out? This time don't write the book value. Last time we wrote the book value. Reason was that in the last question, in the question fair value was not mentioned. When fair value in the question will be mentioned, then you will have to take into account fair value to assess the worth moving out. Worth coming in. Worth coming in 15 plus 13 lakh 10, 13 lakh 25. So this time there is no difference. If there is no difference, we call commercial substance is not there. That is, it lacks commercial substance. Lacks commercial substance. So our response this time will be like this. Response. transaction lags commercial substance. Therefore, assets acquired shall be recognized at book value of assets exchanged. What does it mean? It means when you will pass the entry, your entry will be like this: cash account debit, correct? Then car account debit, car Y account debit. Two, car X account. Asset exchanged is actually this. Car X you are exchanging, correct, for car Y. So you will take the book value of asset exchanged, 13 lakh, as per the standard. Out of 13 lakh, first always write the cash amount, that is 15,000. Now take the difference of these two. So 12,85,000. At this value, car Y will be recognized. So depends upon the commercial substance. If commercial substance is available, then it's fine, fair value will be considered. And if it is not available, then of course the book value will be considered. Is it clear to you or not? I hope so, it is clear. Then we will take up another question. Case study 12, I think it is. One customer from whom rupees 5 lakhs are recoverable for credit sales gives a motor car in full settlement of his dues. Correct? Directors estimate that market value of motor car is 5.25 lakhs. So our entity, let me explain the question. This time our entity is exchanging asset in the form of debtors, because we are supposed to receive from somebody 5 lakhs, correct? And that customer from whom we are supposed to receive 5 lakh, because he was our debtor. So that customer or debtor, what he did, he gave a motor car to us in settlement of his due. Now this motor car has a value of 5.25, but that value is determined by the directors. First of all, do not confuse with it that this value first of all has been determined by directors, so it is not a fair value. It means there is no fair value in this question. And we are supposed to receive 5 lakh because fair value of motor car is also not given. So we shall presume that we are giving 5 lakh and we are receiving 5 lakh. We shall presume it this way because the fair value is not given. So it means there will be no change in cash flows. If there will not be any change in the cash flow, it means transaction lacks the commercial substance. So because transaction lacks the commercial substance, we will reflect the what we call motor car at book value, correct? So our response will be like that. Transaction lacks commercial substance. Commercial substance. And therefore, assets acquired shall be recognized at book value of asset exchanged, that is asset given up. Your entry will be motor car account debit 5 lakhs to debtors account. Debtors moving out, book value of debtors is 5 lakhs. This is how you are supposed to do this question. I hope you got an idea regarding this, correct? We pick up another case study. I just want to equip you with all such facets. This is case study 13, I think so. Case study 13. Z5 traded in means exchange, traded in an old machinery having carrying amount of rupees 1,68,000 and paid the difference in cash of rupees 60,000 for a new machine having cash price of rupees 2,05,000. First you try to understand this question, correct? This is new machine. Its price is 2,05,000. And our entity is having an old machine whose carrying amount or book value is given is 1,68,000. Correct? We are giving this machinery and we are acquiring a new machinery, but question has stated that in order to acquire the new machinery, of course, we have given our old machinery. We have given our old machinery and we have given some cash. In order to acquire new machinery, we are giving an asset, old machinery and cash. Question has also stated that we paid the difference by way of cash and it is 60,000. It means we are giving our old machinery to this fellow and we are paying a cash of 60,000. It means if I subtract 60,000 from 2,05,000, it means my old machinery is considered for 1,45,000. This is the only conclusion we may reach. Are you getting my point or not? In order to acquire the new machinery, we are paying the difference in cash. That means to this fellow to whom we are actually giving our asset, he is telling, I will take your old machinery for 1,45,000 and you pay me the difference of 60,000. So in order to get new machinery of 2,05,000, we are giving our old machinery of, that's a different matter, that old machinery is having a book value of 168, but in exchange transaction it was considered at 1,45,000. That's the difference. That means your old machinery was considered at 1,45,000. Anyway, first we need to find out whether transaction has commercial substance or not. Obviously transaction has commercial substance. Why and how? Because worth going out is 1,68,000 and you are receiving new machine. Your worth out is not only 168 but cash of 60,000 also. correct? A machinery having a book value of 168 is going out. Besides, your cash is also moving out. And new machinery worth 2,05,000 is coming in. Worth in. Worth in. This is our rough work, correct? So 2,05,000. So there is difference between these two flows, outflows or inflows, but there is a difference. If there is a difference, it has a transactional value. If it has a commercial substance, correct? So response will be like this. Transaction has commercial substance. Commercial substance. Full stop. Assets acquired shall be recognized at shall be recognized at fair value. Shall be recognized at fair value. Correct? So your entry will be you are receiving new machine. You will recognize at 2,05,000. In order to get this machine, you are paying a cash of 60,000. Besides, your old machinery is being considered at 1,45,000. Correct? Also, because the value of your old machinery has come down, you will pass another entry to recognize the loss. The statement of P&L account debit to old machinery account. OM, old machinery. From 168 to 145, it is equal to 23,000. Cash price of the machine is given, new machine cash price is given. Cash price is nothing but fair value, remember one thing. So this is how you are going to do questions with respect to exchange. I hope I have been able to make this particular topic as feasible as possible. After having completed 13 case studies, correct, and the topic on exchange, now we are moving further, correct? So now we shall talk about property, plant and equipment purchased for consolidated price. What does it mean? I will let you know in a short while. Property, plant, equipment acquired or purchased for a consolidated price. What does it mean? Let us say this time you have acquired 3 plants, correct? P1, P2, P3, and price you paid is consolidated. That means we are not in the know that what exactly is the price of one particular plant. So we are acquiring some plants, let us say 1, 2, 3 plants, but we are paying a consolidated price. So that is the situation in this particular case that we are going to discuss, correct? PPE purchased for a consolidated price where several items of PPE are purchased for a consolidated price comma, the consideration is apportioned to various items on the basis of their respective fair value. What does it mean? Obviously, you won't be able to understand. Let's have a look over here. Case study. I think it is 14. 13 we have done. It must be 14. Correct? Let us say entity Q9 acquired three machineries and paid consolidated amount rupees 1,000 lakhs. So we have acquired in this case three machineries and we paid a consolidated sum of 1,000 lakhs. That means we are not quite sure what exactly is the cost of one particular machinery because we have paid consolidated amount. So how to segregate this cost among these three machinery? Further, I have given you fair value of respective three machineries is rupees 400 lakhs, 300 lakhs and rupees 800 lakhs. but fair value of each machinery is given to you. Standard provides the guidelines that in order to apportion this 1000 consolidated sum among these three machinery, we need to actually take into account the fair value of three machineries, and in the ratio of this fair value, I am going to divide the consolidated amount among the three machinery. What I want to say, just pay attention here. Let us say these are the three machineries, M1, M2, M3. Correct? Their fair value is 400 lakhs, 300 lakhs and 800 lakhs. The total will be equal to, total fair value of these three machinery will be equal to 1500, correct? 1500. Now, we know that we have paid 1000 rupees, the consolidated sum, so I will have to actually segregate this 1000 among what we call these three machinery. I will take the ratio of the fair value, and accordingly I am going to allocate 1000 to M1, M2 and M3 to determine the cost of each machinery, correct? So that is how we are going to apportion. So out of 1000 rupees, how much will be allocated to M1? So cost of M1 will be 1000 into 400 divided by 1500. This is the ratio of fair value. 400 divided by 1500 into this, that will be equal to I do not know how much. Similarly, 1000 will be apportioned to M2 in the ratio of 300 divided by 1500. Similarly, 1000 into 800 by 1500. So on the basis of the fair value, we are going to allocate the cost in simple words. It will be equal to 1000 into 4 divided by 15, that will be equal to 267. It will be equal to 1000 into 3 divided by 1000 into 3 divided by 15, that comes to 200. And then 1000 into 8 divided by 15, that comes to 533. So the 1000 rupees which we have paid for these three machineries have been allocated in the ratio of their fair value. So we can now say that cost of M1 is 267, cost of M2 is 200 and M3 is 533, correct? These are small topic, finer topic, but still we need to know that. Then we will move over to next one. PPE held by a lessee. Under a finance lease. Finance lease is one in which lessor transfers the entire risk and rewards to the lessee. So let us say lessor has transferred a machinery to a lessee. So lessee is having this machinery as a finance lease, correct? So any PPE held by lessee under a finance lease, what will be the treatment? Cost of an item of PPE held by a lessee under a finance lease will not be covered by this standard. under finance lease FL is accounted as per AS-19, or you can say Ind AS 116. Correct? As per AS-19 or Ind AS 116. So it will not be covered by this particular standard. Similarly, next small finer point is government grants. Government grants related to PPE. Carrying amount of an item of PPE may be reduced by government grant. So if we have received any grant, we can use that grant in what we call reducing the carrying amount. Correct? Carrying amount of an item of PPE may be reduced by government grant, or such grants may be set up as deferred government grant. Generally, the rule is that when we receive what we call grant for a particular fixed asset or for a particular item of PPE, we generally reduce use that grant in reducing the cost of the PPE or carrying amount of PPE. However, there is an alternative treatment is also available. Such grant may be set up as what we call deferred grant. Correct? So these are the finer points which you need to know actually, and then we move over to measurement after recognition. Correct? This is point number 15. Measurement after recognition. Measurement after recognition. In other words, subsequently how we measure the asset. As I told you, there are two what we call methodologies or two options are available with an enterprise. Enterprise may choose to what we call measure them as per cost model or as per what we call revaluation model. Correct? An enterprise should choose A, cost model, or B, revaluation model. Revaluation model for subsequent measurement. For one is initial and now we are talking about subsequent measurement. Before we move further, we should have a bit of idea regarding a class of PPE. A class of PPE, because while discussing revaluation model, we need to have a clear idea what we mean by class of PPE. A class of PPE is a grouping of asset of similar nature. A class of PPE is a grouping that when we are grouping all the asset into one particular class, provided they are having similar nature and similar use of operation. Similar nature and use in operations. So if they have similar nature and use, then we can group them into one particular class. Correct? Generally, classes of PPE could be classes of PPE. You can group them into one, land. Suppose there are 4 lands, so you can make a class of land. That is what we mean by classes of PPE. That means these are the possible classes which you can make. Similarly, you can make land and buildings, a class of land and buildings. Similarly, if there are 5 types of machineries, then you can corroborate them into a class of machinery, and so on. Similarly, if there are several ships, then you can make a class of them. Similarly, aircrafts, motor vehicles, furniture and fixtures, This could be a class. Then you can make a class of office equipments. You can also make a class of bearer plants. So these are the classes which have been suggested. So we will use these term class, so that is why I thought it is better to mention it over here. Of course, now what exactly is the cost model? Suppose I have purchased a machinery 10 years back, and let us say I have reached the end of 11th year now. Sorry, I have reached the end of 10th year now, correct? So at the end of the 10th year, how I am going to reflect the PPE? It depends upon the fact whether I was adopting cost model or I'm going for what we call revaluation model. Suppose if I have opted for cost model, then it will be reflected like this. After recognition of an asset, an item of PPE will be carried like this. Cost, whatever its original cost was there 10 years back when I purchased it, then I will subtract accumulated depreciation. Accumulated depreciation means total depreciation provided during last 10 years, correct? I will reflect that. And in case during last 10 years, if any impairment loss has taken place, I am going to subtract it. So if I am following cost model, this is how I will have to reflect each year in my financials my PPE. I hope you got an idea, correct? When we say we are following cost model, that means whenever you are preparing your financial, your original cost must get reflected, total depreciation provided, and during this phase, if asset has undergone any impairment losses and you have recognized the same, those two shall be what we call reflected here, correct? Now suppose if I was following revaluation model, revaluation, not medal, but model, then what will be the situation? I will take the next sheet. Under revaluation model, after the recognition of an item of PPE, correct? If I want to adopt revaluation model subsequently, then what will be the carrying value? See here, first of all I will check the fair value. On the date of the recognition. On the date of recognition. Correct? When I originally recognize the asset, I will take the fair value of the asset, then subsequent depreciation, of course, whatever depreciation subsequently have taken place, I am going to reflect it. Subsequent depreciation. Then, if any impairment losses have taken place, I will reflect it. You must have seen there is hardly any difference between cost model and revaluation model, at least till up to this stage. Only thing is that in case of what we call cost model, here instead of fair value we take the cost. Here we are going to take the fair value. When we recognize the asset, what was the fair value? Total depreciation, subsequent depreciation means total depreciation up to this point, and total impairment losses up to this point. Up to this point means the point when I am preparing my what we call balance sheet. Important thing is that suppose this asset was acquired 10 years back. So during 10 years, this asset, because fair value must have changed because we have gone for revaluation model. So if we have gone for revaluation model, it means at the end of each year, we are going to see whether our asset has gone up or down, considering the what we call fair value changes. Accordingly, some revaluation must have taken place. Are you getting my point? Which is not the case in case of cost model, because cost will not change. It is as simple as that. So that is the difference. When we say we are adopting revaluation model, that means when I purchase the asset 10 years back, after that, each year I will also see and keep on revaluing my asset, and in case if there have been increase or decrease, I will have to reflect that. So I will simply write here plus or minus revaluation adjustments. Plus or minus revaluation adjustment means during these 10 years, as sometime value might have gone up and sometime value might have gone down. So revaluation adjustment. That is the only difference. Revaluation adjustments. And then you will reflect the value in the financials. Under revaluation method, or should I write this way, if an item of PPE, if an item of PPE is revalued, then the entire class of PPE to which asset belongs, should be revalued. That is why I was trying to tell you the meaning of class earlier. So whenever revaluation, if an entity want to do, they need to take into account that in the class only one item cannot be revalued. They will have to revalue the entire class. That is very important. Suppose we are talking about class machinery and there are 8 machineries. Then entire class means the revaluation of all 8 machineries will take place. If an item of PPE is revalued, then entire class of PPE to which asset belongs should be revalued. The general rule is that almost after every year or after every alternate 2 years, one should actually revalue the asset. So as far as frequency is concerned, we can say revaluation should be made with sufficient regularity. That doesn't mean that you are revaluing the asset sometime after 2 years, sometime after 1 year, and sometime after 5 years. So there is irregularity. There should be regularity. After regular intervals, it means. Now we come to the main point, treatment of what we call revaluation. This is important, very important. Accounting treatment of revaluation. Accounting treatment of revaluation. Please pay attention here, and it is pretty important to understand treatment of revaluation. correct? First time revaluation. First time revaluation. And I'm writing here upwards. What does it mean? That means an entity is first time revaluing its asset and there is an upward movement. Correct? Upward movement means the value of the asset is going up. Then what will be the treatment? See here. With the help of a case study, I am trying to tell you the accounting treatment. I stretch a line as I normally do. Let us say this is 1/4/2050, 1/4/2021. This is 31/3/2022. And here it is 31/3/23. Let us say we acquired PPP on this date. We acquired an item of PPE on this date. Further presuming that its cost or we acquired it for 5 lakh. Correct? Because initial recording is done at cost. So 5 lakh. Now, at the end of the first year, no revaluation was done. At the end of the first year, we did not revalue the asset. Correct? But here, at the end of second year, we decided to revalue the asset. Now, this will be termed as first time revaluation. This is first revaluation. Entity is doing the revaluation first time. And we further presume that first time revaluation resulted in fair value being 6 lakhs. We found that its value is actually 6 lakhs. Obviously, it is a gain to us. And it is a first time revaluation. If there is first time revaluation and there is upward movement, quite obviously, your entry will be PPE account debit because value of asset is increasing. PPE account debit. Value is going up by 1 lakh, so you will write here 1 lakh and 2 revaluation reserve account. RR is known as revaluation reserve account, that is 1 lakh. Are you getting my point or not? It is simple. So, we may say that after second year, this particular asset now will appear on 31/3/23 at a value of 6 lakhs. Now see here what I am trying to tell you. Now we move over to the next point. Earlier I wrote first time revaluation. Now I will write first time revaluation again. First time revaluation. First time revaluation upward but here I have added now but subsequent revaluation downward. That means first time when we revalued, there was upward swing, but later on when we revalued again, we found downward movement. So how the accounting treatment will unfold? That's the question. So in order to comprehend this, I again stretch a line Here I write the date 1/4/21 and PP is 5 lakh, we have already told you, and let us say first year ended here, but no revaluation is made here, 31st of 3/22, no revaluation. We did not revalue asset on this date. Here the first revaluation is made, 31st of 3/23, first revaluation, I will write here, first revaluation, fair value is 6 lakhs, we have already seen. Fair value 6 lakhs, correct? First year ended, we did not make any revaluation. At the end of second year, our first revaluation took place. Then third year, again no revaluation was made. 31st 3/24, no revaluation, correct? However, on 31st of 3/25, we again went for revaluation. So it is subsequent revaluation or second revaluation, you can call it. After first, whatever revaluations will be there, those revaluation can be termed as subsequent revaluation. Where is the red pen? Now, when you did the subsequent revaluation, this is your subsequent or second revaluation. Subsequent revaluation, correct? Subsequent revaluation. When you did the revaluation here, what you found out, just pay attention. Here you found that fair value is now only rupees 4,90,000. 4,90,000. Your original value of the asset is 5 lakh. When you made the first revaluation, there is a gain of 1 lakh. There is a gain of 1 lakh. Value has gone up. But here, from 6 lakh to 4,90,000, you can see value is falling down, and it is falling down by 1,10,000. So how to account this? See here. When we will do the revaluation, first revaluation, you already know the entry, what entry you will pass. On this date, your entry will be PPE account debit to revaluation reserve account. We have just written a moment ago. PPE account debit to revaluation reserve account. Value has gone up by 1 lakh. So this is your entry, correct? However, what will be your entry when you will do the subsequent recording, subsequent revaluation, correct? In case of subsequent revaluation, there is a loss, correct? See here what I am writing. Let me write first. Revaluation reserve account, SPL account, statement of profit or loss account to PPE. One thing is sure, if value is falling down, then asset will have to be decreased, and to decrease the asset, we will credit the asset, correct? PPE will be credited by 1,10,000. It is a loss. It is a loss. Generally, losses are offset by debiting them to profit and loss account, correct? By debiting them to profit and loss account. But here I need to be very, very clear. Before debiting the loss, I need to keep into mind that whether there is any balance, any credit balance existing in the revaluation reserve. Before writing this loss, I need to make sure whether there is any credit balance in the revaluation reserve or not. Yes, there is. There is a credit balance of 1 lakh because earlier we had a gain. So out of this 1,10,000, first I am going to set off this loss against the credit balance existing in the revaluation reserve. So revaluation reserve credit balance is 1 lakh, so I will debit it by 1 lakh. And if the loss amount is still remains, then only it will be debited to statement of P&L account. Are you getting my point or not? This is a loss. This loss will be debited to revaluation reserve first, provided there is a credit balance in the revaluation reserve. And the difference will be debited to statement of profit and loss account. This is the point which you need to understand. Is it clear to you or not? So, this was your case study, you can say, 16. Now, see, first time revaluation, downward. Let us say we are making first time revaluation, but this time we are having a downward swing, correct? So what I am going to do? We will try to understand this. As usual, original date is 1/4/21. PPE acquired on this date is 5 lakhs. No revaluation on 31st of 3/22. But we made a revaluation at the end of second year, that is on 31st of 3/23. First revaluation. And here the fair value is just 4,50,000. So at the time of first revaluation, we find there is a loss, correct, this time. So if there is a loss, because this is the first time revaluation, there is a loss. But it is a first time revaluation, so no question of any balance in the revaluation reserve. Balance in revaluation reserve could exist only when you are making subsequent revaluation, correct? So, because there is no balance in the revaluation reserve, entire loss will be debited to statement of P&L. So 50,000 will be debited to statement of P&L, and you will write here 2 PPE. That is 50,000. Is it clear to you or not? Correct? So no problem in this, at least. Now we take next case, case D. First time revaluation. First time revaluation results in downward movement. Subsequent revaluation results in upward movement. Correct? Subsequent is upward. First loss, then gain. So in order to comprehend this one, we write here 1/4/2021. Correct? PPE 5 lakh. Then 31st of 3/22. No revaluation. 31st of 3/23 first revaluation. Now first revaluation, fair value 4,50,000 as we just saw. So there is a downward movement, correct? Because it is a first time revaluation, the entry which you will pass will be equal to a statement of P&L to PPE. $50,000, $50,000, correct? This is the entry. Again, no revaluation on 31st of 3/24. However, on 31st of 3/25, subsequent revaluation takes place. Second revaluation or subsequent. So subsequent revaluation. Now subsequent revaluation results in a fair value of rupees 5,25,000. That means from 450 to 525, it means 75,000 value of this particular PPE has gone up by. So now how to record it? When I will pass the entry will be like this. Without any iota of doubt, property, plant and equipment will be debited because value is going up by 75,000 from 450 to 5,25,000. So 75,000. Generally, if there is any gain, please pay attention. That gain, generally we credit to revaluation reserve. Generally we credit it to revaluation reserve, as we saw in first case or second case, whatever you may call it. Here, I cannot credit this entire 75,000 to revaluation reserve. Why? Because a loss is already appearing here in a statement of P&L due to revaluation. If due to revaluation you have recorded a loss, then you have a right to revert that loss on account of revaluation increment. Because there is a revaluation, value has gone up now. So whatever loss due to revaluation which you debited earlier, you can revert it, you can reverse it. So that is the reason first I am going to revert the loss which I earlier recorded due to revaluation. Not every type of loss, correct? So first I am going to credit 50,000. So this way the loss which I the loss which I recorded earlier is now technically set off in the sense that we are reversing it. So we are crediting it. So this loss is now nullified. Now remaining gain you can take to revaluation reserve. I hope you got the treatment. So it's an interesting one and you should not have any difficulty in comprehending these issues. This was case study 18, you can say so, just for reference. Correct. We are going to discuss some more issues with respect to subsequent what we call recordings, correct? So just wait, let me see which was the point I was writing earlier. Accounting treatment of revaluation, I wrote it, measurement and recognition 16-17. Okay. Today I'm not feeling well, you must have noticed by now. Anyway, the climate here in Delhi is changing and changing by leaps and bounds. So everyone is having cough and cold. Anyway, treatment of, first write treatment of subsequent A. Cost of day-to-day servicing. Once we have acquired an asset, it is quite obvious that sub-servicing need to be done, like cost of labor, consumables, correct? So that asset remains in a proper condition. So cost of day-to-day servicing are primarily you can say cost of labor and consumables and may include cost of small parts. The purpose of such expenditure, I have already told you, the purpose of such expenditure is normally described as repairs and maintenance. So whenever such expenditure is incurred, we tend to say that some repairs and maintenance is being done of PPE. It is needless to add that such expenditure is charged to a statement of P&L. Such expenditure is expensed, that is, such expenditure is charged to a statement of P&L. It will not be capitalized. Similarly, B, replacement parts of PPE. Replacement parts of PPE. Parts of PPE may require replacements at regular intervals. For example, aircraft interiors such as seats may require replacements several times. Quite obvious. So often an entity has to incur, as I said, cost in the form of replacement of what we call any particular what we call thing, as I gave the example with respect to aircraft, that in case of seats, we require replacement several times. Correct? So, as far as cost of replacement is concerned, enterprise must recognize such cost. I will write here. Enterprise recognizes such costs in the cost of PPE. That means such cost is capitalized. Similarly, regular major inspections, we have to carry out inspections many a times at regular interval. Without any doubt, such costs, because major inspections is written, so such costs are capitalized. Included. In the carrying cost of PPE or carrying amount of PPE. So you need to have a fair bit of idea regarding what we call such cost. Of course, we will take up some what we call case studies to supplement the things which we have done. Correct? This is case studies 18. Last time we did 17. S4 has scrapped a semi-automatic machine. Semi-automatic machine. Semi-automatic machine and replaced it with more advanced fully automatic machine. Fully automatic machine. Automatic machine. Correct? Which has doubled the output. Double the output. At the same time, new machine was moved to a more suitable place which involves building a new foundation. Building a new foundation. Now basically in this case I'm interested in knowing from you which are the costs which you will have to capitalize and which are the costs which you will have to expense. It is written that S4 has been scrapped. S4 has scrapped semi-automatic machine. Old machine has been scrapped. So my response will be like this. Written down value of semi-automatic machine, SAM, semi-automatic machine, should be written off. Should be written off to statement of P&L. No doubt about that. Correct? 1. 2. Whole expenditure on a new fully automatic machine, FAM, fully automatic machine. B, we have to move the new machine, so repositioning of new fully automatic machine. And C, building of foundations. Building of foundations. Should be capitalized. Should be capitalized. So these are the expenditure which the entity will have to capitalize, while these are the expenses, point number 1, which will have to be expensed. Correct? Now we write case study 19. Under case study 19, right here, S7 Limited undertook repairs and overhauling of its machinery at a cost of 250 lakhs. It's quite a heavy amount. At a cost of 250 lakhs. $50 lakhs to maintain it in good condition. And capitalized the whole amount, capitalized the amount as it is more than 25% of the original cost. Problem here is that S7, no doubt about that, they have spent very heavy amount, but the basis on which they are capitalizing is wrong. Generally, as per the standard, the size of the expenditure doesn't matter much unless and until there will be enhancement, there will be increase in future economic benefits. We cannot capitalize the expenditure. So that is the reason. My answer will be like this. Size of the expenditure, let me start by writing this way. Contention of the management. Contention means claim. Contention of the management. Contention of the management. Contention of the management to capitalize said expenditure on the ground that it is more than 25% is incorrect. Is incorrect, as expenditure cannot be capitalized unless it enhances increases future economic benefits, FEB, future economic benefits. So size of the matter is irrelevant, correct? Moreover, it is also given in the question that in order to keep the machinery in good condition, it is not what we call increasing the capacity of the machinery, correct? So this was one question, case study. Then we write another one, case study 20. During the current year, P9 Limited made following made following expenditures relating to its plant building, relating to its plant buildings. Repairs 400, partial replacement of roof tiles, you make it 4 lakhs. Roof tiles, $50,000. Correct? C, substantial improvements to the electrical wirings $10 lakhs. So in this case, I'm not solving it, I'm simply telling you which are the expense, correct, which you are going to capitalize. You will treat repairs as revenue expenditure. I will simply write R. It will be treated as revenue expenditure, it will be expensed. Partial replacement, because it is partial replacement, correct, so better to treat it as revenue expenditure. However, substantial improvement means quite major improvement, so quite obviously it is going to improve the what we call benefits, so it should be capitalized, correct? So such questions you need to have an idea about, and then we are going to the last facet of this particular what we call standard, that is with respect to depreciation, and we'll talk about that at length in the upcoming session. This standard is still continuous, correct? So in this standard now we'll touch upon what we call an issue which seems very simple, that is depreciation. So this particular standard also deals with depreciation. Remember one thing now. So what are the what we call issues with respect to depreciation? Honestly speaking, most of the things you are already very well aware of, but in spite of that, we will do even this part comprehensively. So depreciation we take up now. Depreciation. Although you are very well aware of these facts which I am going to put up over here, but I have a habit of putting each and every facet. If we are taking up the topic, then each facet must be covered. Obviously, I am not going to ask you that you let me know the factors upon which the depreciation depends, correct? You know very well. So I am simply going to write here, depreciation depends upon, depreciation depends upon we know that depreciation depends upon what? Depreciation depends upon, just wait. Okay, I will write it this way. A, useful life. Depreciation obviously will depend upon the useful life. I'm not going to ask you what exactly the useful life is, correct? Useful life, simple words, means expected utility of the asset to the entity, correct? So in terms of this particular what we call standard, we define what we call useful life as the expected utility to the entity. Expected utility to the entity. That is how useful life is defined, and you know it very well. Then depreciation obviously is also going to depend upon residual value. Residual value. Again, I am not going to ask you what is residual value, correct? Residual value basically is defined as the estimated amount that an entity would currently obtain from disposal of asset. If I am going to dispose of my asset today, the value which I am going to receive is nothing but the residual value, disposal of the asset. And third, depreciation depends upon cost, obviously, cost of the asset. And we have already seen what exactly is the cost of the asset. So these are the three things upon which depreciation depends. Are you getting my point or not? Continuing the serial numbering series, this is 18, that is just for reference, it is not mandatory for you to write, correct? Now, second point with respect to depreciation is depreciable amount. We know what is depreciable amount. Depreciable amount means cost of the asset, obviously, minus residual value. This is nothing but the depreciable amount. In fact, this is the amount which we are going to depreciate, correct? Depreciable amount should be allocated as per this standard. Depreciable amount should be allocated on a systematic basis over asset's life. We know that depreciable amount is definitely allocated, and it is allocated on the basis of assets useful life. We already know, and this is nothing but depreciation charge, ultimately which we debit to what we call statement of P&L over assets useful life. Then, after having a look over all these points, we also know, and in fact standard also guides, that residual value, useful life and depreciation methods of asset should be reviewed in fact annually by the entity on each reporting date. And in case if there is any change, then change in what we call residual value or depreciation method are considered as changes in estimates, and these changes in estimates are effected prospectively, not retrospectively. Prospectively means in future. So these are the points which you also need to know. So I will write them. Residual value, RV, I'm using short form. Residual value, useful life, UL, short form, correct? And depreciable methods, DM, depreciable or depreciation methods, DM, of an asset should be reviewed annually, So entity must review these methods, correct, at each reporting date. Obviously, when we are going to review, there might be some changes then. So changes in residual value, depreciation methods, and useful life are considered, or simply write, are considered as changes in estimates. These are not considered as changes in what we call accounting policy. These are considered as changes in estimates and are accounted for prospectively, not retrospectively, prospectively. Correct? So, in case if we bring about any changes, we need not require to do any adjustment with respect to the depreciation charges, which we have already what we call accounted for. That means no retrospective adjustment is needed, only prospectively. In future, we will simply use the new method or changed method. Another important point, we know that depreciation is a charge, or depreciation is charged to statement of P&L. Depreciation is charged to statement of P&L without any doubt, unless it is included depreciation is included in the carrying amount of an asset. What does it mean? Logically speaking, depreciation is a loss to us. We should always what we call charge it to SPL. But sometimes depreciation on a particular item of PPE is not charged to a statement of P&L. Rather, it is included as a part of the cost of that PPE. and that becomes the case, let us say an entity is actually, you can say, involved in developmental activities and it is using a PPE over there. So in that case, depreciation on that PPE will not be charged to what we call P&L, rather it will be what we call charged to that PPE, or in simple word, it will be considered as a cost of that PPE. Is it clear to you? So, generally entry we pass is statement of P&L account debit to depreciation, no doubt about that. So depreciation is generally debited to what we call a statement of P&L. But if, as I said, depreciation is on an item of PPE, correct? And that PPE is being used, say, in a research or developmental activity. In that case, we are going to charge the depreciation to the carrying cost of PPE. And if we are going to actually charge the depreciation to the carrying cost of the PPE, indirectly it means the cost of PPE is actually getting what we call increased. So entry will be PPE account debit to depreciation account. Correct? Just to cite the case so that you remember, let us say an entity is engaged in development activity and it is using a PPE for the same. In that case, depreciation on that PPE, correct, will be charged to what we call that particular PPE. Similarly, if an entity is what we call engaged in mining or extraction activity and using an PPE, then of course the depreciation again will be charged to what we call that PPE. Is it clear to you? So these are the points, as I said, even though looks very simple points, but you need to actually know all these points, correct? Then we write next point with respect to depreciation only. We know that depreciation begins when the asset is actually available for use, correct? Available for use. That's a different matter that we might not be using it, but if it is available for use, then we should actually provide depreciation. Depreciation begins when asset is available, for use. When asset is available for use. Just to cite the case, suppose asset is available here for use. But entity starts using from this date. So depreciation will start from this particular point. Depreciation will start from this particular point. Are you getting my point or not? Then depreciation ceases at earlier of the date A on which the date on which asset the date on which asset just wait the date on which asset is held the date on which asset is held for disposal or sale or B the date of derecognition. So, whichever date will fall earlier, on that date we will start what we call charging depreciation, correct? Then, depreciation methods. Depreciation method. Depreciation methods, of course, should be such that it clearly what we call reflects the future economic benefits which are expected to be consumed by the entity. First of all, okay, I will write it also. Depreciation method used should reflect the pattern in which assets future economic benefits FEB, I will use the short form, future economic benefits, FEBs, future economic benefits are expected to be consumed by the entity. Consumed by the entity. Now, here you have to be clear because basically, as I told in the beginning, we are doing both. Not only AS-10, we are not only doing, Ind AS, what we call 16, but AS-10 also, because absolutely same. But in case if anywhere difference will be there, I need to state that also. So regarding the depreciation method, you have to be clear that Ind AS, when I write Ind AS, it means Ind AS 16 suggests or allow, I should write. Ind AS 16 allows SLM and written down value methods, correct? However, AS-10 allows SLM, straight line method, written down value method, that is diminishing value method, and units of production method. So you need to know this difference. Units of production method. But Ind AS allows only two methods. Obviously, it is quite common thing that depreciation method once selected actually should reflect the expected pattern of the future economic benefits of the asset, correct? And once we have gone for that particular method, then we have to actually use it consistently over the period, correct? Unless there is change in the what we call expected pattern of the consumption. If you want me to write, I will write this also, depreciation method. Depreciation method applied should be consistent, from period to period, it means from one period to another one, period to period, unless there is change in expected pattern of consumption. So in case if we find that there is a change in pattern of consumption from the earlier visualized one, obviously then we will have to go for the change. But as far as possible, we should use what we call depreciation method consistently from one period to another one. So these are the issues with respect to depreciation which you should be aware of, correct? Then we take up another issue that is, in fact, we took that issue up a moment ago also, derecognition. We have already discussed it earlier, correct? That an asset, okay, I will write it here. Carrying amount of an item of PPE, carrying amount of an item of PPE shall be depreciated, shall be derecognized when, shall be derecognized, you write A, on disposal, obviously when you are going to dispose the asset you will have to derecognize it, or B, when no future economic benefits, are expected, correct? So when we find that no future economic benefits will be there, we should derecognize it, correct? Obviously, when we are going to de-recognize, we will either have some gain or loss, correct? So, I will write here, any gain or loss any gain or loss on disposal that is difference between net sale proceeds, because there might be some expenses, net sale proceeds and carrying amount correct, should be recognized in SPL. There is nothing to actually explain regarding this point, but still, or I will pick up the what we call case study later on, correct? Let me actually finish up this point. You want me to? Okay. Message flushes immediately, so better. There is nothing to actually explain in this particular point. Just pay attention here. Let us say this is the current year of an entity and 1/4/21, and here it is 31/3/22. Let us say somewhere here on 31st 12/21 there is an asset, there is a PPE, an item of PPE. Under PPE there could be many items we have already seen, correct? So there is an item of PPE whose carrying amount say is 5 lakhs. And on this date, entity feels that it is better to dispose of this particular asset because it is not bringing in, let us say, any expected sort of benefits. So on this date, entity disposed it off. Entity decides to dispose it. So disposed it, say for 4 lakhs. So in this case, what I am going to do, correct? When I will sell the assets, when I will sell off this particular asset, I will receive a cash of rupees 4 lakh, number one. There will be a loss of 1 lakh, and the difference and PPE will be credited, that means de-recognized. You didn't get me? Okay. See here, bank account debit. How much I am receiving? 4 lakhs. Loss, statement of P&L. That is 1 lakh. So PPE, which is existing in the balance sheet at 5 lakh, now has been credited at 5 lakh. So PPE is de-recognized, and difference between the what we call net sale proceeds, that is 4 lakh, and the carrying amount 1 lakh is debited to statement of P&L. There is nothing in it. Correct? Then we will take one more thing here, impairment. This is my serial number .20. impairment. Of course, standard because there is separate standard for the same. Here I will simply write any loss on account of impairment should be recognized in a statement of P&L. We will talk about impairment in the standard when we will take up, correct? Now, another important point is with respect to what we call changes in existing decommissioning. You might be thinking, sir, we have done already this part. No. Decommissioning, although we have confronted this word earlier, changes in existing, decommissioning, restoration, and other liabilities. Try to understand this point, and it is vital to understand. Let us say, okay, I will use this pen only. Let us say an entity on this date 1/4/20, correct? An entity here acquires a plant and machinery for 50 lakhs. Acquires a plant and machinery for 50 lakh, correct? And please try to remember the example which I did earlier. In fact, that is the reason why you might be feeling that you have already done this particular topic earlier. Let us say we bought a machinery and we stored this machinery in a rented premises. This was the sort of case study which we did earlier, correct? And because we have stored this machinery on a rented premises, so whenever we will leave that premises, we will have to, of course, decommission this machinery, correct? We have to actually pull out this machinery. That is nothing but decommissioning. Besides, we have to restore because some damage has been caused to the premises. So we will have to restore it. So whenever an asset is acquired, in case at that time if there will be some decommissioning liability or some restoration liability, such liability at that time is visualized by discounting the same. Are you getting my point or not? Do you remember? Let us say we acquired this asset for 50 lakhs and let us say there is a liability associated, decommissioning. I'm simply putting of liability. It means it is decommissioning liability or it is restoration liability or it is any other sort of liability. But this liability has to be incurred, let us say here, after 10th year. 1 year, that is 21, okay. Second year, 22. Third year, 23. Fourth year, 25. Okay, I will take 5 years only. First year will end here, second here, third here, fourth year, fifth year. Let us say we have, let us say life of the machinery is 5 years, so we have taken the what we call this particular premises for 5 years, correct? So we visualize that after 5th year, when we will leave the what we call premises, in that particular case, we will have to decommission this machinery and we will have to restore the building. That is, we have to bring it to the original position. This sort of what we call case study, which we did earlier. Let us say when we acquired the asset, we visualize this liability, and it is known as decommissioning liability or restoration liability. And let us say it's discounted value. I am simply giving you discounted value. Discounted value is 5 lakh. That means we have already discounted it, correct? Because I cannot give you a discount factor here right now. Otherwise, it will make the things clumsy. We want to comprehend the things. So originally, that means at the time of initial recording, I will allocate 50 lakh plus 5 lakh as cost to this particular item. That means I am going to recognize that machinery which I acquired for 50 at 55. As we know, decommissioning expenses or restoration expenses are going to be added to the cost, isn't it or not? This sort of actually question which we did earlier. Now we are dealing with changes in existing. Changes. Let us say we have reached the third year, correct? At the end of the third year, we find or we have a hunch, correct? I'm looking at the light. Just wait. Okay, I have some time. I can continue. So, at the end of the third year, let us say we believe that this liability which we are estimating at 5 lakh, this liability which we are estimating at 5 lakh, because this liability has to be incurred here. But we are visualizing it here that when we will reach the end of the 5th year, we may have to actually incur 5 lakh worth of what we call expenses on restoration or what we call on decommissioning. So it is quite obvious and it is quite natural that with the passage of the time, these visualization might get altered, might get changed. So this existing liability of 5 lakh, suddenly we feel that has gone up to 7 lakh. And this could happen due to any other reason. Due to what we call, let us say, rise in prices in the market, correct, of material labor. Or it could be due to imposition of some more duty due to the coronavirus and due to the what we call turmoil all over the world here, in the world economy, correct? So due to any other reason, this existing liability has changed. In fact, it has gone up by 2 lakh. So obviously, if there is change in liability, I will have to incorporate it. How I am going to incorporate it? Just pay attention here, correct? My initial recording will be 50 lakh plus 5 lakh, 55 lakh, but we are not talking about the what we call recording of the entire asset. We are simply talking about the changes in. So if this change has taken place, how you are going to? Now, could you tell me what will be the change? Could you tell me? See here. As per this standard, if any such change takes place, then you will pass this entry. You will not consider it as a gain. You will not consider it as a gain. Don't think that your liability, you will not consider it as a loss, Don't think that your liability has gone up, so you have incurred a loss. In fact, of course that is a loss, but in different manner. See here. Your entry in this case will be, because your liability has gone up, correct? So any changes in what we call existing decommissioning, restoration and other liabilities, any changes in existing liability with respect to decommission, restoration or any other liability with respect to the asset, correct, will not be taken to the statement of P&L. Remember one thing. So how to actually then account it? You will account it this way. PPE account debit to liability account. Your liability has gone up by 2 lakhs. This increase in liability, you are not adjusting it in a statement of P&L, rather you are adjusting it in the carrying amount of the PPE. So because you are adjusting it in the carrying amount of the PPE, now your PPE, which you noted down at 55 lakh initially, correct? When you will reach the end of the third year, correct? Because here you are expecting a change and you will have to incorporate it. Then this value of 55 will move up to 57. It means changes in liability on account of all these things which I just mentioned will not be incorporated in statement of P&L, rather it will be adjusted to the carrying amount of the what we call debt item or PPE, regarding which these liabilities are changing. Is it clear to you? So, but problem here is that here there is no problem because we acquired the asset for 55 and we visualized an expense of 5 that will become a part of this, so we will record the asset at 55. But subsequent recording, as we have already seen, could be either at cost or could be either what we call at revaluation method, because entity has a choice. It can go for what we call revaluation method or it can go for cost method. So either you will pass this entry, only if you are adopting cost model, correct? If you are adopting cost model, then only you will pass this entry. However, if you are not adopting cost method and you are adopting actually revaluation model, in that case, what will be the entry? In case of revaluation model, just pay attention. Liability has increased, so you will write here revaluation reserve account debit 2 lakh to liability account. Revaluation reserve account debit to liability account. This is the entry which you are going to pass provided this asset is being maintained as per revaluation method. Suppose liability would have come down, then you would have reversed the entry, so no problem in it. So these are the points which you need to know. We have picked up point number 21 I'm talking about with respect to changes. Earlier we simply did what we call decommissioning and restoration expenses. Here we are dealing up with changes, correct? So changes will be adjusted generally in cost, because generally entities go for cost model. But however, if an entity decides to go for revaluation model, then entry will be like this. So now we will pick up a very simple topic, retirement also. Topic whether happens to be simple or tough, we have to do everything. Retirements. Correct? Retirement means sometime an entity decides to retire the asset from the active use. So items of PPE retired from active use they have been retired and held, but still they are held for disposal. But these assets are held by enterprise. Intention is to dispose them. For disposal should be stated at lower of A, carrying amount of the asset, B, net realizable value. Net realizable value, correct? Case study 22. In this case study, correct, we presume that in the beginning of year 1, cost of asset cost of an item of PPE is 20 lakhs. 20 lakhs, correct? We further presume that the life of this asset is 10 years. Life is 10 years. And we further presume that residual value at the end of 10 year of course is 3%. Is 3%, correct? When we reach the end of 7th year, let us say, end of 7th year, entity estimates that this asset has become useless. At the end of the 7th year, entity estimates that this asset has become useless, assessed as useless. And entity also estimates that it has realizable value, RV, realizable value of rupees 6,20,000. Correct? That means at the end of the 7th year, entity has decided that this particular asset should be retired because it has become useless. Number one. Number two, entity estimates, it is not yet disposing it off, but it is estimating that this asset, if sold, could fetch 6,20,000. That means it is a case of an asset which is useless but still with the entity. So at the end of the 7th year, when financials would be drawn, at what value we should actually reflect this asset. That is the theme. So I need to find the carrying amount at the end of the 7th year. I will have to compare it with what we call 6,20,000. So whichever is the lower one, at that figure I am going to recognize the asset. Besides, the difference will also be recognized as a loss. Correct? That is the point. So here is the solution. A, we will take the cost. Cost is 20 lakhs. Correct? We will take the residual value, which is 3%. That is 3% of cost. %, 60,000, I think. So the depreciable amount is depreciable amount. Rupees 19,40,000. This is your depreciable amount. Correct? Of course, this is the amount which you should actually depreciate or allocate over 10 years period of time, because the original life is 10 years. So if I happen to divide it by 10, correct, what will I get? I will take the next sheet. I will get per year depreciation. So depreciation per year will be equal to 1,94,000. 19,40,000 divided by 10, correct? This is your per year depreciation. Suppose if I multiply it by 7 years, if I multiply it with 7, I will get what? I will get 13,58,000. This is total depreciation for 7 years. Total depreciation for 7 years, correct? So now you can find the carrying amount. Carrying amount at the end of the 7th year, will be equal to how much? Original cost is 20 lakhs. Subtract from there 13,58,000. So we can say 6,42,000 is the carrying amount. Now we are going to compare it with the net realizable value. NRV, that is estimated realizable value, is 6,20,000. So at the end of the 7th year, PPE should be stated at 6,20,000, should be stated at 6,20,000, and loss of difference of these two, 22,000, should also be debited to statement of P&L. Also be debited to statement of P&L. This should be your answer. Is it clear to you or not? Correct? Case study 23. In this case study, let us say cost of PPE is 10 lakhs, correct? You can call it cost or carrying amount appearing in the books at 10 lakh. And let us say here this is first year, let us say this is 7th year. Entity assesses it to be useless, and decide to sell. Expected ERV, or simply expected realizable value, is 3,10,000. 3,10,000, correct? We presume further that life is originally 10 years and residual value is 3%. Residual value is 3%. Question is determine the amount, loss or gain on retirement. This question, case study, is absolutely similar to the 22, which you will do it by yourself. My point is this, correct? Case study 24. In this case study, there is an entity by the name of, say, K99, and it has a machine. And here, on this date, retired from active use. Retired from active use. But not held for sale. Not held for sale. Entity is not holding it down for disposal, correct? Management management wants to depreciate the same in the current year. Do you agree? My point is this. If an asset has been retired but not held for sale, not held for sale, so do you agree? Logically speaking, entity cannot actually charge depreciation on this particular asset. Correct? As per the standard, depreciation of an asset ceases at earlier of a date on which asset is retired from active use, or the date on which asset is de-recognized. Correct? So because in this case asset has been retired, so we can say as such entity cannot depreciate the asset in the current year. Asset in the current year. Entity cannot depreciate it. Is it clear to you? Let us say entity acquires plant and machinery at rupees 100 lakhs from his supplier. From his supplier, correct? first year ends, second year ends, third year ends. Correct? Entity acquires plant and machinery for rupees 100 lakh from his supplier. Balance payable is 10 lakhs. We acquired the asset for 100 lakhs, so we might have paid what we call 90 lakhs, so 10 lakh is payable. Now here, this information I am talking about on this date, when we are acquiring the machinery. At the end of the third year, correct? Supplier waived the balance. The supplier was a nice fellow. He told us that you need not require to pay 10 lakh. It's okay, your account is settled. Try to understand. When you had purchased the machinery, what entry you would have written at that time? Plant and machinery account debit, 100 lakhs. To supplier, 100 lakhs. The second entry, just to make the point clear, on this date, when you purchase the asset, you must have passed this entry, plant and machinery account debit, 100 lakhs to supplier account, 100 lakhs. And because you have paid 90 lakhs, your next entry will be supplier account debit 100 lakhs to cash 90 lakhs. That means you are still supposed to pay to supplier 10 lakhs. Are you getting my point or not? This is the outstanding amount. That means there is a balance in supplier's account of 10 lakh. But here, at the end of the third year, supplier actually simply says you need not require to pay off. So it is a case of change in liability. You remember? Just few sessions ago, actually, we did that. So it is a case of change in liability. So this waiving of balance will not be adjusted in statement of P&L. I did talk about this particular fact. It will be adjusted either in the cost of the asset, provided we are following the cost model, or what we call in revaluation reserve, if we are following the revaluation method. That is the point. So I will write it here. Waiving off of balance balance of rupees 10 lakhs shall not be adjusted in a statement of P&L, rather in carrying amount of plant and machinery, provided we are following cost model, provided cost model is being followed, cost model is being followed. or in revaluation reserve account if revaluation model is being followed. Correct? So you need to know all these things and case studies and bit of some remaining tiny issues we are going to touch upon. Correct? Now this is the topic which I am going to take, and this is where is my serial numbering. Let me have a look over that. These are the sheets lying here, 23. This is with respect to acquisition of PPE on deferred credit, What does it mean? I will take the help of case study. And what is the serial numbering of case study? Again, I forget. Anyway, sheets are lying here itself. So case study 25th we did last. It must be 26th then. Correct? I will use a case study to make you understand this particular point. So right along with me. P17 Limited purchased a car on 1/4/21 for rupees 18 lakhs. For rupees 18 lakhs. Of course, from a supplier who normally offers 3 months credit facility. It is his general policy that he will offer you 3 months credit facility. However, P13, in fact P17, acquired it under an agreement whereby it would pay the amount of the car after period of 2 months, 2 years. So we made an arrangement with him that we will pay you after 2 years. He normally offers 3 months credit facility. Now try to understand in this. That means it is a case of PPE on deferred credit, correct? Because we are going to make the payment after 2 years. So what we are going to do, how to determine the cost under this cost of PPE will be cost of PPE will be cash price equivalent. Cash price equivalent. What is this cash price equivalent? Just pay attention. We will find the present value of rupees 18 lakhs okay, I will write here borrowing rate in the market is 10%. Borrowing rate is 10% per annum. Correct? So we will determine the present value because this 18 lakh we are going to pay after what we call 2 years. So 18 lakhs, I will take the present value of 18 lakh at 10% borrowing rate, that is 10% discount factor for 2 years. So present value of 18 lakh, because 18 lakh will move out of the entity after 2 years. So what is its cash equivalent today? Correct? So 18 lakhs into 0.826. This is the discount factor. 10% 2 years, so its present value is 0.826. Now if you multiply 18 lakh with this, you will get 1486800. I think so. It means even though you are paying 18 lakh, but actually this 18 lakh you are making after 2 years. So today this 18 lakh is equal to this 18 lakh which you are going to pay 2 years later. So today it is equal to 14,86,800. That is the point. Therefore, cost of car will be equal to 14,86,800 and balance of rupees 3,13,200, that is 18 lakhs minus this figure 14,86,800. Balance of rupees 3,13,200 shall be treated as interest payment. Shall be treated as interest payment because you availed of the time facility of what we got 2 years. Shall be treated as interest payment. So this is the point. Interest payment, and of course shall be charged to statement of P&L. So this was the point I just wanted to bring to your notice, and now we will do some comprehensive question to finish it off. Correct? Case study 26 we did. Case study 27. Now in this case study, let us say there is an entity by the name of, you think of any name. Let us say V7 is the name of the entity, correct? And on this date, it acquires a PPE for 15 lakhs. It acquires a PPE of 15 lakhs, presuming further that life is 15 years. Life 15 years. Presuming further that 15 years are ending somewhere here, correct? After the end of the life, residual value is 3 lakhs. Residual value is 3 lakhs, correct? Now, at the end of the 4th year, let us say 4th year is ending somewhere here. End of 4th year, at the end of 4th year, entity assesses that A, on revaluation, value is 20% more. That means at the end of the 4th year, we may say on account of revaluation, value has gone up by 20%. Further, entity assesses remaining life is only 3. Remaining life is only 7 years. Remaining life is only 7 years. When we acquired the asset, we were under the impression that life is 15 years. But at the end of the 4th year, as we know that we keep on what we call reviewing the useful lives, so we found that life remaining life of this asset is 7 years. Correct? Remaining life of this asset is 7 years. Actually, after the 4th year, technically the remaining life is actually how much? Technically the remaining life is 11 years. But now we find that remaining life is only 7 years. Correct? Then at the end of 7th year, let us say 7th year is somewhere here. End of 7th year. We find that realizable value is actually 2 lakhs. At the end of the what we call 7th year, we find that realizable value of this particular asset is actually 2 lakh and not what we call 3 lakh. Correct? So this is the situation in this particular question. So what we are supposed to do? See here. We will take the cost, of course. Original cost is 15 lakhs. I will write 15 lakhs. Then I will take into account the residual value. Originally my residual value is 3 lakhs. The difference of these two will give us depreciable amount or depreciable value. So depreciable amount is actually 12 lakh. This is the total amount which we need to depreciate over the entire life. In the beginning, entire life is 15 years, so I divide it by 15. When I divide it by 15, I will get depreciation per year. Depreciation per year will be equal to 80,000. Let me check it. 12 lakh divided by 15. Yes, 80,000. Now, at the end of 4th year, correct? So, I will multiply it with 4. Multiply it with 4. It will tell me the total depreciation up to 4th year. Total depreciation up to 4th year. Total depreciation up to 4th year will be equal to 3,20,000. Correct? Now, at the end of the 4th year, total depreciation is 3,20,000. So, I will write now carrying amount E, then write F. Carrying amount. Carrying amount will be original cost was 15 lakhs. Subtract from here total depreciation in these 4 years. So you will get 15 lakhs minus 320. 11 lakh 80,000. This is the carrying amount at the end of the 4th year. However, at the end of the 4th year, what happens? At the end of the 4th year, we find that there is an increment on account of revaluation. So we will write here revaluation adjustment. So value has gone up by 20%. You will write 20%. 20% of 11 lakh 80. 2 lakh 36,000. This will become the revised carrying amount. At the end of the 4th year, revised carrying amount is this much. 236 plus 1180, 14 lakh 16,000. This becomes your revised carrying amount, correct? Now, it means what will be the depreciation in the 5th year, 6th year and 7th year? See here, revised carrying amount is 14 lakh 16,000, correct? And now our remaining life is, how much is the remaining life? Our remaining life is 7 years. That means this 14 lakh 16,000 will have to be depreciated during next 7 years. That's quite obvious, isn't it or not? So, I divide it by 7. If I will divide it by 7, it will give me depreciation per year for next 7 years. next 7 years. For next 7 years, correct? So 14,16,000 divided by 7, this figure is pretty clumsy, 202,286. 202,286. This is the depreciation per year for next 7 years, correct? Now what happens? Just pay attention. Suppose I want to know carrying amount at the end of seventh year. Now your seventh year is ending here. Remember here, even after 4 years, there is life remaining for next 7 years. And we have in total reached 7 years. Even after 4th year, 7 years are left. That means total period come into play will be 11 years. See here, suppose this is my first year, this is my second year, this is my third year, this is my 4th year, correct? This is 5th year, this is 6th year, this is 7th year. However, after 4th year, still 7 years are remaining. That means 8th year, 9th year, 10th year, 11, 12, 13, 14, 15, etc. Are you getting my point or not? So in total, now we have reached, that means after 4th year, 1, 2, 3. Now we have reached the 7th year. At the end of 7th year, just pay attention, carrying amount at the end of the 7th year, first I want to know. See here, I have already got the revised carrying amount after 4th year. Revised carrying amount after 4th year is 14,16,000. 14,16,000. Now I depreciate the asset for 5th year. That means at the end of 5th year, I will charge a depreciation of 202,286. Then similarly, I will charge the depreciation in the 6th year. In fact, at the end of the 6th year, again it will be 202,286. And then again I am going to charge the depreciation. Now depreciation 5, 6, that is 7. Now depreciation is equal to this much. So at the end of the 7th year, situation is like this: 1416,000 minus 202,286 minus 202,286 minus 202,286. According to my calculation, it is 809,142. This is the carrying amount at the end of the 7th year. Similarly, in the 8th year, I will charge the depreciation 202,286. But at the end of the 7th year, this asset has been now retired. In fact, sorry, I forgot to write it. At the end of the 7th year, realizable value is 2 lakh and asset retired. Now, at the end of the 7th year, this is the carrying amount. But estimated realizable value estimated realizable value is just 2 lakhs. Just 2 lakhs. That means there is a loss of 609,142. 60942. At the end of the 7th year, in the balance sheet, you will reflect this item at this value. We are presuming that it is held for sale, correct? And loss we will recognize in statement of P&L. So, this is a comprehensive question. I try to make it, correct? Then, I think we have done most of the questions, most of the issues, and I don't think actually anything else, honestly speaking, you require. You can completely and faithfully bank upon these case studies. As I keep on telling, we have tried our level best to cover each and every point with respect to this particular standard, and we will sign off with the last case study. The case study which we just did is actually 27, and now we'll, as I said, we'll sign off with 28. Correct? You can expect a question like this, the one we did earlier and the one I am doing now. Case study 27, 28. 28. In this case study, let us say this is, okay, let us say this is the date 1/4/21, and we have a plant and machinery with a carrying amount of 1,50,000 on this date. Correct? At the end of our first year will end somewhere here, that is 31st/3/22. Next year will end somewhere here, 31st/3/23. That is second year. And third year will end somewhere here, 31st/3/24. Let us say at the end of the third year, seventh year is coming to mind every time. At the end of the third year, as per the review conducted by the enterprise, it was found that remaining useful life is 4 years. Remaining life is 4 years. When we purchased the plant, let us say at that time, life was estimated at 6 years. When we initially purchased the plant, we estimated the life 6 year, correct? 4th year, 5th year, 6th year. At that time, we expected life to be 6 years, and we also estimated a residual value of 10% of cost. As per our original estimation, after the end of the third year, logically 3 years should be remaining. But we made a review of useful life, we found remaining life is 4 years. So remaining life is 4 years means at the end of the third year, there are next 4 more years. That means now you will move to 7th year. When you conducted this survey, so your remaining life will extend to now 7th year. As per original estimation, it was 6, but because of the what we call review of the remaining life, you find that not 3, rather 4 next years are still remaining. Correct? So this is the situation. Question is simple, not very tough. So such sort of question you may have to face. You have to compute the amount of depreciation, no doubt about that. So this is the solution. As usual, first of all, we shall write cost. Cost is 1,50,000. Then I will write here residual value. 10% of cost, that is 15,000. I will subtract 15,000 from 1,50,000, 1,35,000. Correct? This is your depreciable amount. Depreciable amount. Now, I will divide it by useful life. Useful life is 6 years as per our original estimation. So, per year depreciation will be 67,500. How much? 67,500. Because you have the total depreciation, in fact, now let me multiply it with 3, because at the end of the third year, so 3 years depreciation I need, I multiply it by 3. So, no, how much it is? Oh, per year depreciation is 22,500. The problem is that you told, I'm asking for per year depreciation, not total depreciation for 3 years. Correct? I'm talking to the students sitting down over here. Anyway, so total depreciation is 67. They have already told me that in advance. 67,500, very fast. Anyway, so total depreciation for 3 years is this much. You have done fine, good. Now we can find the carrying amount at the end of the third year. Carrying amount at the end of the third year will be equal to 1,50,000 minus 67,500. That will be equal to 82,500. Correct? At the end of the third year, carrying amount is this much. However, at the end of the third year, you find that remaining life is only 4 years, and okay, I will also make another change just to make you acquaint, and let us say now residual value is 5%. Just you should be in the know of each and every aspect. Correct? See here, at the end of the third year, this is the carrying amount. I am simply writing plus minus revaluation as we did in the last. There is no revaluation this time. If there would have been any, you would have taken that into account. Now, residual value now you are estimating that residual value is 5%. So 5% of original cost. Remember one thing. 5% of 1,50,000. That will be equal to 7,500. In the last question, new revised value was at the end of the 7th year, not at the end of the 4th year. Here, at the end of the third year, we are estimating that now the revised value will be 7,500. So this is your carrying amount at the end of the third year, or in the beginning of the 4th year, you can also say so. No revaluation, but there is change in residual life, so it will become your revised carrying amount. You can also call it revised depreciable amount. Revised carrying amount is now, you will subtract this, so that will be equal to 75,000. Fortunately, it's a nice figure, correct? Now remaining life is 4 years. You divide it by 4. What you get? You get depreciation per year for fourth year, at the end of the 4th year, 5th year, 6th year and 7th year each. So after the end of the 3rd year, in the next year you will charge this much depreciation, and in the subsequent years you will charge depreciation of 18,750, correct? So with that, we have comprehensively covered this particular Ind AS, AS, whatever you would like to say. So everything is absolutely same. With this standard, as I told in the beginning, we have killed 2 stones. We have done AS-10, we have done Ind AS-16, correct? So very comprehensively, lots of case studies we on our part, as always, strive to do. So we have done, in fact, today, since last 2-3 days, I'm not feeling well, so you must have noticed that. But anyway, we have to carry on in spite of that. So with that, we come to the end of this particular standard now, correct?